We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynг.org for more details. CFA Society Nigeria, making finance a force for good.
Good morning, everyone, and thank you for joining us this morning for the Level 2 Revision Bootcamp. We promise that it's going to be an educative and interactive session throughout today and tomorrow. We'd like you to note that our recordings or our sessions are going to be streamed live on YouTube. So, peradventure, you can finish up with us, or you have classes that are not going to be taken. Please go to our YouTube channel and look for our past recordings there to brush up. Would like you to also note that today we'll be having 3 classes. The first one is financial statement analysis, which is going to be taken by Ayokunle Olubumi, CFA. The second class today is corporate issuers, and it's going to be taken by Segun Owadokun, CFA. And the third class for today is equity investment by Damilare Ojo, CFA. We promise once again that these classes are going to be educative and very interactive. And we'll look forward to seeing you tomorrow again for the second round of the revision bootcamp for level 2, with 3 classes also to be taken. The first one for tomorrow will be quantitative method quants by Oluwatoyin Boyo, CFA. Ethics and Professional Standards by Adiola Gbadebo, CFA. And derivatives will be taken by Fola Abimbola, CFA. All 3 tomorrow. So we wish you all the best in your exams, and we look forward to seeing you at the top. Do have a blessed day ahead. Ayokunle, over to you.
Good morning, everybody. Please, can you confirm that you can hear me? Okay, cool. Okay, so let me just share my screen. Okay, right. Can you see my screen also? Right? Can you see my screen?
Yes.
Okay, fantastic. Okay. My name is Ayokunle Olubumi, and like Bukola said, we'll be taking a quick dive into FSA, financial statement analysis. And as I suspect a lot of you've done the reading. So this is going to be like a recap of what we have in the syllabus. So because of time, we'll focus on 3 major topic areas, which are intercorporate investment, employee compensation, and analyzing financial institutions. I know that there are some overlap. For instance, the last 2 topics, integration and quality of financial statements, you've really done it in level 1. So that's why I just think it's not the best use of time for us to also go over it here. So I will also suggest, as we'll be going through the program, please, if you have any question, feel free to interrupt and even ask your question before, because I don't know how much time we will have left after the presentation to take questions. Although I'll try and move a bit fast, but please, if something is not clear, quickly stop me and ask your question so that all of us are on the same page. Okay. Right. And I think the first thing is the learning objective. And I will suggest that please, as part of your revision, right, please, for each subject area, for each topic, look at the learning objective, read it and be sure that you digested it, because when they're testing you, when they're going to test you, the focus will be on the learning objective, right? Suppose look at each one of them and be sure that you're comfortable with it. So let's start with the learning objective for intercorporate investment. There are 3, like you all know. The first one says that you should be able to describe the classification, measurements, and disclosure under IFRS for 1, investment in financial assets, investment in associates, joint ventures, business combination, and special purpose and variable interest entities. So we should be able to distinguish between IFRS and US GAAP in the classification, measurements, and disclosures of investment in financial assets, investments in associates, JVs, business combination, SPs, and VIEs. And lastly, to analyze how different methods used to account for intercorporate investment affect financial statements and ratios. So please, as part of your revision, for each of the topics, check that you are comfortable with the learning objectives. right? Before you even proceed, and before you say that, look, I'm comfortable with this and I'm ready to go into your the exam proper. Like you all know, intercorporate investments is a company investing in another company, right? And I'm sure by now you also know that for under the syllabus, the focus is on how the investor, not the investing company, how the investor company accounts for that particular investment. And I'm sure you also know that there are 4 types of intercorporate investments. The first one is financial assets, right? We will call passive investments, right? And here, this is the one in which you have neither control nor influence over the investee as the investor, right? And please note, what we said is you have no significant control or influence, right? So what we use at time as the ownership guide is if you have below 20% ownership interest, but not like I said ownership guide. So meaning that it's possible for you to have above 20% and it will still be classified as investment in financial assets if you don't have significant control and if you don't even have you don't have significant influence and you don't have control, right? That's the ultimate decider. But the ownership guide is just basically what we use. And of course, that is for equity investments. We all know that all debt instruments will be classified as investments in financial assets. Of course, we also have investments in associates, right, in which you have significant influence but not control. And what we use as ownership guide is if you have between 20 and 49.9% ownership. JVs is when control is shared, right? And also, remember that at times you can even have, it doesn't mean that the ownership stake is equal, but control is shared. Like a good example is the NNPC JV with Shell, in which NNPC has 40% and Shell has 60%. But despite that, control is being shared by both parties equally, right? So ownership is just a guide, it's not the ultimate decider. And of course, business combination is when you have ownership above 50%. So you notice that for investment in financial asset, that's where you have all the debt instruments. Although you can also have equity instruments in that particular bucket. For all the other 3 buckets, they are all equity instruments. Let's talk a bit about investment in financial assets, right? And like we all know, those ones can be classified into 3, right? Amortized cost, fair value through profit or loss, and fair value through OCI. Okay? For the amortized cost, here you only have debt instruments, or let me put it this way. Let me say instruments with the maturity date, because the financial markets keep evolving. There's even now, we have hybrid instruments, but if you have a maturity date, it can be classified as amortized cost. And then under the, for those that are classified as amortized cost, we all know that the ultimate plan on how to recover your money, which we can call the business model, is owed to collect the contractual cash flow. So meaning that here, the plan is that all the contractual cash flow, be it coupon, be it interest income, all that to actually even, that's all you're actually even using to recover your cash flow from that particular investment. You are not planning to sell it before the maturity date. So the next question is, how do we record that investments in financial assets, particularly those in the amortized cost? On the balance sheet, right, we record the fair value on the investments day, right? And then subsequently, we record the value using the effective, you record it as amortized cost using the effective interest rate method. I'm sure, remember, we already did this in level 1, okay? And what we have under the income statements, right, what we have there is simply the interest income. And I'm sure you also remember that in level 1, we're told that interest income can be different from coupon. And it's only when you have a par instrument that your interest income will be equals to coupon. So your interest income is your coupon plus or minus the bond discount on your bond premium. I'm sure we read all that ones in level 1. Okay. Then for the second type of instrument under the investment in financial assets, which is fair value through profit or loss. Here, right, what we have here is either you can have debt instruments and you can also have equity instruments there. Okay. Then you can also, there are also the third type of instrument that we have there, what we call derivative instruments. So if you have any derivative instrument, I'm sure you'll remember that your derivative instrument, you can use it to make money or you can use it to hedge a particular risk. For those that used to hedge a particular risk, the underlying assets is where the underlying asset, that is where that particular instrument will be recorded. But those derivative instruments that are not used to hedge any particular risk or any particular risk, that's it. That is just, and you are just invested in that particular instrument to just make money. All those ones will be classified as fair value through profit or loss. Therefore, the debt instruments, right? Please note, all debt instrument that is held for trading will be classified as fair value through profit or loss. And then there's some instrument that it also should actually not be in fair value through profit or loss classification. However, to avoid what we call accounting mismatch, what do we mean by that? For instance, the liability that you've used to raise the funds that you are using to finance that particular asset. The way it is actually even structured, it seems a bit to look like something that is marked to market, right? You can actually put the associated assets into the fair value through profit or loss buckets. That's basically what we mean by avoiding accounting mismatch. For the equity instruments, right, there are two types of equity instrument that you see in the fair value through profit or loss. For those that are held for trading, will always be in this particular bucket. So any equity instrument that is held for trading will be classified as fair value through profit or loss. For other equity instruments, you have a choice. You can either classify it as fair value through profit or loss or fair value through OCI. And I'm sure you already know now that that particular decision is irrevocable. You have to just stay by it until you dispose that particular instrument. On the balance sheet, how do you value this particular investment? Like we all know, we mark it to market, right? So at every reporting period, we get the current fair value of that particular instrument, and that's what will be recorded on the balance sheet. For the income statement, what we have there will be your interest income if it's a debt instrument, investment income if it's an equity instrument. You have mark-to-market gains and losses, or you have realized gain and losses also there. Okay, so for instance, for the fair value through profit or loss, the business model, or what I always revert to, the way in which you want to even get your cash back is what we call hold to sell, meaning that your plan is that, look, I want to sell this particular instrument. That's the primary business model for the fair value through profit or loss. And the third one, which is fair value through profit through OCI, right? Those ones I call those ones hold to collect to sell, hold to collect or sell, right? So that means that for instruments that you have there, your plan is either you want to hold it to maturity or you want to actually even sell it. So it gives you the leeway. So you have that particular that flexibility for instruments in that particular bucket. Right. And then, of course, for debt instruments, are those that you want to hold to sell or you want to collect. For equity instruments, remember, the equity instrument that you have there will be those that are not trading and then has been elected to be classified through OCI. Okay. For the balance sheet valuation, what we do is to mark it to market, right? However, the mark-to-market gain or losses goes into your what? OCI. So meaning that in the income statement, what you see will be your interest income, your dividend income, and realized gains or losses. So your unrealized gain or losses under fair value through OCI, you see it in the what? In the statement of comprehensive, your other comprehensive income. Okay. Now, what about classification of financial assets? Right? Like I mentioned earlier, for equity instruments, you are not allowed to reclassify it. Okay? Wherever it is at initial state, that is where it will be until it leaves your books. However, for debt instruments, right, you are given a minimal leeway to reclassify. And that minimal leeway is you can only reclassify if there is a change in the business model of the organization. So it doesn't mean the business model of that particular instrument, but I'm talking about the business model of the organization. So what do I mean? For instance, let's assume that you are assuming that is a bank. Assume that before you were a mortgage bank, now you want to change to a merchant bank. You can see that your business model has changed, right? Or it could be that you were a merchant bank, you want to become a commercial bank. Just that one that shows that the business model of the organization has changed, not that of the instrument. Anything except that, you are not allowed to classify debt instruments. Okay? And I'm sure some of us have been around, we notice that that's the major difference between IFRS 9 that we're using now and IAS 39. And then let's even assume that you are now even allowed to reclassify and you now want to reclassify. We always say that the change is prospective. So meaning that what do you do? On the day that you are reclassifying, what do? You mark it to market, and then it takes the form or it takes the valuation or it uses the valuation that you use for those in the bucket where it's going to. So for instance, what do I mean? Let's assume that it's moving from amortized cost to fair value through profit or loss. You mark it to market, and going forward, you mark that particular instrument to market. Or let's assume that it's coming from the fair value through OCI to the amortized cost. What you do here is that you first mark it to market, and going forward, in valuing that instrument, what you do is that you use the effective interest rate method to amortize that particular instrument. Right. Let's talk a bit. I think that's that for investment in financial assets. Let's talk a bit about investment in associates. We always say that for investment in associates, the only thing that you see there are equity instruments. Don't forget what I said earlier, that it's only investment in financial asset that you have debt instruments. Okay, right. And then for associates, we always say that these are entities in which the investor have significant influence but no control. Right? You can and that what simply means that is that for every major decision, your opinion will be heard, but it doesn't mean that the organization is bound to abide by your own opinion. You can have your say, but it doesn't necessarily mean that you have your will. So what we use as the ownership guide here is between 20 and 50% ownership. I'm sorry, not even 50%, let's say 49.9% ownership stake. But remember what I said, that's not the ultimate decider. The ultimate decider is to show that you have influence but no control. Okay? And one of the things that can show that you have significant influence, irrespective of your ownership interest, particularly assuming that you have less than 20% ownership stake, what are the things that will show that you still have significant influence over that particular institution? If you have representative on the board of directors of the investing company, if there are particular transactions between the investor and the investing company, particularly if those transactions are consummated not in an arm's length transaction. Okay, so that basically means that probably there are some concession. It's not based on the market rates, right? And then also, if the investor company participates in the policy making process of the investing company, if there is interchange of managerial personnel, and of course, when you have technology dependency of the investing company on the investor, that one can show us that the investor has a material influence on the investing company, although the percentage ownership is less than 20%. In accounting for investment in associates, what you see on the income statement is just a line. Although in the notes to the account, you can see the breakdown of that. Same thing in the balance sheet, right? Just have a line, right? On the balance sheet, you can call it investment in associates, but you see the breakdown in the notes to the account. In the income statement, you can have what we call, some call it equity income, some call it income from associates. But it's when you go to the notes to the account that you see the breakdown, and that's why it's called a one-line consolidation, right? And then in accounting for it, there are two methods that you can use. You can use the equity method, or you can use the what? The fair value method. So let's talk a bit briefly about the fair value method. The fair value method, like the name implies, what we do is you just mark it to market. So meaning that what goes into the income statement will be the dividends income, and then the mark to market gain or losses. Right? Of course, the realized gain or losses will also go into the income statement. But on the balance sheet, what you do is that you mark it to market. Then, however, the use of this fair value method is highly restricted, right? Particularly under IFRS. So under IFRS, only a few companies, those are doing unit trust insurance company, mutual funds, and just a few others are allowed to use the fair value method. However, under US GAAP, any company can use the fair value method. So any company can use either the equity method or the fair value method under US GAAP. However, the decision is irrevocable. So once you've made that decision, you must abide by it. Now let's talk about the equity method, right? Which is the most prominent under IFRS. Okay, like I mentioned earlier, we call it one line consolidation because you only see one line on the balance sheet. So let's talk about the balance sheet valuation first. So what you see on the balance sheet, the first thing that you record there will be the amounts paid for that particular investment. So the investor company, the first thing you see there will be the amount paid by the investor company for that particular investment on the day of the investment. Subsequently, what you do is that this income the valuation of that particular associate is going to increase by the investor's share of the investee profits. Recall that assuming you have 30% stake in a particular company, so that means that every return that is coming from that particular for that particular investment, all their income statements, you are entitled to 30% of it. And if they are paying dividend, you are also entitled to 30% of it. Right? So this particular company, after the year end, what you see is that your ownership interest, right? So for instance, 30% of the profits of that particular associate will increase the size of your investments in that particular associate. And if it's actually losses, the share of those losses will reduce your valuation of that particular investment. In terms of dividend, we see dividend as return of capital. So what you see here is that we reduce the size of the investment by your own share of the dividend paid by that particular associate. And please note, under the equity method, your dividend goes to the balance sheet. It doesn't go to the income statement. And we use it to reduce the size of the investment. Now, under the equity method, whatever amount that was paid to acquire that particular associate or to acquire that interest in the associate, we need to analyze it to find out what are the components and what are the things that actually even comprise that particular amount that we are investing. What does it represent? Please note that you won't see this breakdown in the financial statement, but in preparing the financial statements, you need to do that from the outset so that you'll be able to account for it appropriately subsequently. And what you see is that the investment in associate, the amount that you pay to acquire that investment, can represent three things. One, can represent the share of the associates, your proportionate share of the associate's net assets. It can represent your own share of the excess of the fair value of the asset of the associate above the book value. So for instance, particularly in this environment when we have inflationary pressure, you notice that look, the value of assets keep on growing. However, the book value remains the same. Even it will actually even be reducing because you are depreciating it. So if you want to acquire a particular associate, in determining how much you will pay, they won't be looking at the book value, they'll be looking at the fair value of that particular asset. So that's why you see that at times the amount that you paid will be higher than the proportionate share of the associate's net assets. And the third thing that can actually even that can even comprise and determine how much you are paying to acquire an associate can be what we call goodwill. And like we all know, what's goodwill? Goodwill is simply the premium paid above the fair value of the associate's net assets. Now, the next question is, why is it important for us to do this computation? The reason why it's important is that the two sides, which are the fair value of the excess of the fair value of the assets above the book value and that goodwill, those will be amortized into the income statement subsequently. Okay, and how do we do that? For the excess of the fair value above the book value of the asset, that one will be amortized into the income statement using the way the underlying asset is being treated. So what do I mean? Let's assume that the underlying asset that is leading to, that has the fair value above the book value is a building, and that building is being depreciated. It is the depreciation method used for the building. That's what we use to amortize that particular excess purchase price. So for instance, assuming that it's been depreciated by over the next 10 years equally, you can do the same thing for the excess of fair value above the book value. And of course, for goodwill, we all know that what we do for goodwill is to test it for impairment. How do we test the goodwill for impairment under the investments in associates, right? Under IFRS, what we do is that you compare the carrying value of that particular investment. So in testing the goodwill, although we are testing the goodwill for impairment, what we need to do is to test the old investments for impairment, because remember that under investment in associates, that particular goodwill premium is coming for that particular entire asset. So how do we now test it for impairments? Under IFRS, like I said, you compare the carrying value to the recoverable amount. And remember, I'm sure you all remember that the recoverable amount is the IR of fair value less cost, fair value less selling cost, or the value in use. The IR of that particular amount to compare with the carrying value. So the excess of the carrying value above the recoverable value is what we say is showing that, look, that particular goodwill has been impaired. That means that we've overstated that particular asset, and the first area where we need to shave it off will be the goodwill. And please note that under IFRS, goodwill impairments can be reversed if the value of the assets increased, right? However, don't forget that it cannot go above the initial valuation of that asset. I'm sure you remember we did that one in level 1. Okay. While under US GAAP, it's something similar, but it's just the nomenclature that is different. So what we just do is that we say that we are comparing the fair value of the investment with the carrying value. And if the fair value is significantly below if the fair value is below, if it's below the carrying value, and the decline is actually deemed to be permanent, we say that the asset is impaired. And that difference, it is amortized. It is actually even what's charged into the income statement. And please note that under US GAAP, the asset value cannot go up again. So that means that under US GAAP, there cannot be reversal of impairment of goodwill, although that one is allowable under IFRS. Although under IFRS, you can't go above the initial valuation of the assets. Now, also note that, at times you can have transaction between the associates and the parent company, between the investor and the investee. To avoid using it for financial engineering, what the standard says is that when you have a transaction between the investor and the investee, that particular transaction, or let me say the profit from that transaction, before we can say that it is realized, it must be confirmed by either using the product that was procured or you are selling it to a third party. So what do I mean? So for instance, assuming that the parent acquires some goods from the associates, before the profit we can say that it has been earned, is either those goods are used by the parent or they've sold it to the third party. So if not all the goods have been sold or have been used, the one that are yet to be used or sold, we assume that that profit hasn't been realized. And what we do is that from the equity income or income from associates, we deduct that unearned profits from it. So for instance, when there's a transaction, the profits on it will be like $100, right? However, we've only confirmed 80%. So the 20%, which represents $20, this year, we're going to deduct it from the equity income, or what we call the income from associates. Okay? While the following year, or let me say subsequent period, when that particular profit has been realized, that is when it will be added back to the equity income. Okay? Now, let's really talk about business combination. So remember that I said that business combination is simply where you have when you have control, and that means that you have at a minimum, you have like 100%, sorry, you have like 50% equity stake. Sorry, 50% equity stake in that particular company. And then what that one means is that, and then the accounting standard now says that if you have control, right, on more than one entity, you need to prepare what we call a group account, or some call it consolidated account, showing your interest, the combined interest in all the entities where you have control. So the next question is, how do we prepare this consolidated these consolidated accounts. Let's first look at the balance sheet, right? So under the balance sheet, how do we prepare the consolidated balance sheet? The first thing that we need to do is to first get the fair value of all the assets and liabilities of the subsidiary or the acquiring company. So meaning that, assuming that we acquire a subsidiary today, the first thing we'll have to do is to get the fair value of all the assets and liabilities. And don't forget that based on accounting standard, I'm sure we remember that we learned that one in level 1, that there are some assets that although you have it, you can't put it on your books. For instance, internally developed software. But when you are trying to prepare the group account, you need to actually even get the valuation of all of these assets that were hitherto off the books. And you need to now bring them into the consolidated balance sheets. So what do we do after getting the fair value of the assets and the liabilities of the acquiring company? We now do is that we now add the acquirees or the subsidiaries' assets and liabilities. We add it to the parent. Please note, here, what we are adding is the assets and liabilities of the subsidiaries. We don't add the equity of the subsidiary. So we add that to the assets and then the liability of the parent to now get the what? The group account. So there are some other things that we need to do. We need to compute goodwill. We'll talk a bit soon about what we need to do, how to compute for goodwill. Then also we need to adjust for how we paid for that acquisition. And recall that most often you either pay for the acquisition by cash or by shares. So meaning that assuming we paid for cash, right, in consolidating the cash, recall that we take the cash of the parent plus the cash of the subsidiary. We need to deduct the amount that we paid out to acquire that particular associate, okay? And assuming that it's shares that were issued, right, to acquire that particular associate, we need to adjust our equity for those shares, okay? Now, in the case where you have the parents controlling less than 100% after the acquisition, that means we have what we call non-controlling interest or minority interest in the group. And that needs to be adjusted for in equity, because think about it. We've added the assets of the subsidiary 100%. We've added the liability of the subsidiary 100%, although we control less than 100%. So the best way we can actually make that balance sheet to balance, right, is to adjust for the non-controlling interest in equity. So that means that when we're paying the balance sheet, there are only two conditions in which you will have to adjust in for your shareholders' funds or your equity. Okay, so either you are paying for the acquisition using shares, or you have non-controlling interest. We'll talk a bit about how to compute non-controlling interest, how to compute it here very soon. So let's talk briefly about the income statement, preparing the consolidated income statement. So what you need to do is that for the revenue, you take the subsidiary's revenue, add it to the parent's revenue 100%. You take the expense also of the parents, you add the subsidiaries onto it, right? You deduct it together. And then when you have non-controlling interest, you need to deduct the non-controlling interest from the consolidated profits. So how do you compute that? Is the non-controlling interest multiplied by, right? Multiplied by the subsidiary's PAT. So what do I mean? Let's assume that we control the subsidiary 80%. So that means that 20% does not belong to us, okay? What we now do is that the 20% multiplied by the subsidiary's profit. Let's assume that the profit of the subsidiary was $200 million. So that means that $200 million multiplied by 20%, that's 40 million, right? So we need to deduct that one from the group's profit before we now get the overall profits of the group, because that's the one that belongs to us. So the overall profit that belongs to us, it goes into the retained earnings, while the share, the non-controlling interest, goes into the non-controlling interest in the equity. Recall that in preparing the balance sheets, we also have the non-controlling interest in the equity portion. Okay. Now let's talk briefly about computation of goodwill. How do you determine goodwill? So there are two approaches or two methods that can be used in preparing goodwill. There's what we call the full goodwill method and also what we call the partial goodwill method. The full goodwill method is the only method allowed under US GAAP to compute goodwill. And so that's why oftentimes you see some people calling it the US GAAP approach to goodwill, right? It means the same thing. Then the partial goodwill method is allowed under IFRS. That means that it's not allowed under US GAAP. And that's why some people call it the IFRS approach to goodwill. But please note, under IFRS, you can use either the full goodwill or partial goodwill. Nazar.
Yeah, good morning.
Morning.
Do you mind going over the computation for non-controlling interest again?
Okay, not a problem. Here, please note, I'm talking about computing the non-controlling interest under the income statement. I will still come back to the non-controlling interest under in the balance sheet. Now, let's assume that we've computed the non-controlling interest on the balance sheet. Of course, we'll talk about it later, how you get that. Now, in preparing the consolidated income statement, after adding the parents' income to that of the subsidiary, that of the subsidiary's expenses, you know what we'll get? You get the consolidated profits, you can call that. But recall that if you have non-controlling interest, the overall profit does not belong to the parents. There's a portion that belongs to the non-controlling interest guys or the minority interests. So let's say for the sake of example, right? Like the example I gave, the subsidiary made profit of 200 million. So what you've seen is that in preparing the consolidated income statement, we've added that the whole 200 million to that of the parents. However, to get a share of the non-controlling interest, it will be a non-controlling interest multiplied by that subsidiary's profit after tax, not the total group's profit after tax. So, like I said, assuming that the subsidiary, what we have in these investments is 20% non-controlling interest. And recall I said that the subsidiary made profit of $200 million. So 20% of $200 million is 40,000, right? Am I correct? Okay, 40 million, yeah. So that 40 million will deduct it from the overall group's consolidated profit. Let's assume that the group's overall consolidated profit is $460 million. So that means that 460 million, we need to share it into two. The one that belongs to the parent and the one that belongs to the subsidiary. So $460 million, like we've determined that 40 million belongs to subsidiary, right? We deduct it from it. Then the remaining, which will now be 420, belongs to the parents. Like we all know, your profit goes into your retained earning. So the one that goes into the retained earning is the 420 that belongs to the parents. The 40 that belongs to the non-controlling interest, it goes to the non-controlling interest portion in equity. So what you have in a as your what do you call it? Your retained earnings is increasing. The non-controlling interest portion in equity will also be increasing by that particular their share of the non-controlling interest profit. Now, is it clear?
Yeah, thank you.
Okay, cool. Okay, right. So coming back to the goodwill computation, okay, like I said, under the full goodwill is the only approach allowed under US GAAP, but IFRS, we allow both the full goodwill and the partial goodwill approach. And of course, the question is, how do we use the full goodwill approach and how do we use the partial goodwill approach? I think for the full goodwill approach, I always say that the best way to think about it is that, look, you are trying to determine, we said that goodwill is simply the premium that you are placing above the fair value of the company's net assets. So the way to think about it is that for full goodwill, we are looking at what is the premium that the whole market, right, is placing over a particular company's net assets. So partial, but that's for full goodwill. While for partial goodwill, think about it as we acquire a particular company, whether we want to acquire this particular company, what is the premium that we are placing on it? So let's take that one after the other. So for full goodwill, we look at what is the valuation of this company. Okay? Vis-a-vis the fair value of the company's net assets. And for a company that is listed, for example, it's very easy to get the valuation. The valuation is simply the share price multiplied by the number of shares outstanding. So if the full valuation of the company is, let's say, $1 million, right? And the fair value of the company's net assets is 900,000. So that difference is 100. Okay, that is under the full goodwill approach. Remember, I said that the full goodwill approach, you can think about that the total market approach. But for partial goodwill, think about it as you, the company that you want to acquire, what is the premium that you are placing. And how do we do that? What we now do is that, what is the amount that we want to pay as consideration for the acquisition, right? Less the proportionate share that we are acquiring. Now, maybe I should also add that partial goodwill is most useful when you're acquiring less than 100%. When you're acquiring 100%, oftentimes, particularly under IFRS, you notice that what we use most of the time will be the full goodwill approach. So let's assume that this company I'm acquiring 70%. Okay? Remember that the valuation of that particular company, the net assets is 900, like I've mentioned. So all I need to do is what is 70% of 900? That will be the value of the company's net assets. If I deduct the amount that I want to pay for it, that will help me determine the difference from the partial goodwill method. So for instance, 70% of 900 is 630. Okay, so that is the share of the company's net assets. So let's assume that in that particular acquisition, we are ready to pay 800 million, right? For, let's say, 70%. You'll see that the difference between 800 and 630, I think that is 770. So you could see that the same transaction under full goodwill. Okay, let's assume that we want to pay 700, right? Okay, so that what you see is that here under the partial goodwill, the same transaction, the partial goodwill is 70, while the full goodwill is what? Is 100. Okay, Chiamaka, are you for us or against us? Somebody is trying to think of. Okay, right. So let's now talk about non-controlling interest or minority interest computation. Okay. Now, under the minority interest or non-controlling interest, we have two approaches also. We can use what we call the full goodwill approach, or we can use the partial goodwill approach. Okay. But please note, if you use the full goodwill to compute your goodwill, you also use the full goodwill method under the minority controlling interest. Right? Or sorry, under the minority interest computation. Okay? And if you use the partial goodwill method in computing goodwill, is the same approach that you use when you are computing the minority interest. So what is the full goodwill approach under the minority interest? Here is the share of the minority interest multiplied by the subsidiary's fair value, which is the full size of that particular investment. So for instance, let's assume that let's continue with this example. Remember that we said that the fair value of that the company's valuation is $1 million. Okay, and remember that the minority interest is 30% because we acquired 70%. So using the full goodwill approach, 30% of $1 million is going to be what? 300,000. Okay, that's for full goodwill. While for partial goodwill, right? The partial goodwill or for the partial goodwill method for non-controlling interest is simply the non-controlling interest percentage multiplied by the proportionate share of the associate's net assets. So for instance here, recall that we said that the fair value of the identifiable net assets is 900,000. Okay, 30% of 900,000 is going to be what? 270. So if you are using the partial goodwill approach, the non-controlling interest is going to be 270, while if you are using the full goodwill approach, the minority interest is going to be what? 300. Now, let's do a comparison of the full goodwill and the partial goodwill. Okay, right. Like I mentioned earlier, of course, we all know how to compute full goodwill and partial goodwill. And like we all know, the computation of non-controlling interest depends on the method that we use in computing goodwill. And of course, you also realize that, look, for full goodwill, the amount that you get as the value of the goodwill is going to be higher than what you get when you are using the partial goodwill method. Same thing also for minority interest. What you get in computing the minority interest, when you're using the full goodwill approach, is going to be way higher than what you get, assuming that using the partial goodwill method. So the implication of that is that, look, if you are using the full goodwill method, your asset is going to be bigger. Same thing also your equity, if you are using your full goodwill method relative to when you are using the partial goodwill. And that typically have an implication for your profitability ratios. So meaning that when you are using the full goodwill method, your ROA and your ROE will be lower because the asset size will actually be higher, the equity will be higher. However, the profits will remain the same. The profit after tax will remain the same, right? So if you have higher asset and higher equity, I'm sure you know that, look, your ROA and ROE will also reduce. So let's talk a bit about goodwill impairment. Like we all know, we need to test the goodwill for impairment at least once in a year. And in testing goodwill for impairments, it is done at what we can call at the operating segment level. Let's put it that way, right? And that operating segment, it can be called the cash generating unit, or it can be called the reporting unit. Under IFRS, we call it cash generating unit. Under US GAAP, we call it reporting unit. It's the same thing, it's just simply the operating segment unit. So what the implication of that is that, look, whenever you acquire a particular company, your goodwill, you need to share it among all the operating segments. As a matter of fact, the truth of the matter is that even before you acquire a company, for you to determine the amount of goodwill that you have, which is a premium, it is the premium that you'll be able to generate from the operating segments. That is what you will determine the amount of, is when you accumulate and add everything together. The premium that you get from every operating segment, that's what will determine what you want to share, what you want to pay as the premium and the company totally. So simply is that they're just even sharing the goodwill based on what you planned before. Alfred.
Yes, sorry, just take the ROE and ROI again, which will be higher under full or partial.
Okay. Thank you. So remember that I said that even from my explanation, that from the example that I gave, full goodwill will be higher than partial goodwill. In terms of, I'm talking about the goodwill size and the size of the non-controlling interest. You know, the non-controlling interest is in equity. So the implication is that if you use the full goodwill, your total asset size will be higher and your equity size will be higher. However, irrespective of the method that you use in computing your goodwill or in computing your non-controlling interest, it doesn't have any implication on the profitability. Because from the example I gave earlier, and I remember when Neza asked the question, you notice that, look, irrespective of the method that we use, it doesn't affect our computation of non-controlling interest on the income statement. So the profit will remain the same, irrespective of what we've used in computing the method. Either we're using full goodwill approach or the total or the partial goodwill approach. So if the asset is higher under full goodwill, if the equity is higher under full goodwill, you will notice that if we have the same profits, you notice the ROA would now be lower under full goodwill. And then the ROE will also be lower under the full goodwill method relative to the partial goodwill.
Thank you.
Alfred,
Thank you.
yeah. Okay, fantastic. Okay, right. So like I said, so we do the goodwill impairment test at the operating segment level. And under US GAAP, we call it reporting unit. Under IFRS, we call it the cash generating unit. Okay? So like I said, typically when we have goodwill, you share it among different operating segments. So, of course, under IFRS, we call it the cash generating unit. So how do you now test for impairments under IFRS? Under IFRS, we call it the single step approach. So meaning that what we do is that, look, you actually even you compare the carrying value of that operating segment with the recoverable amount. I'm sure we remember the recoverable amount, the higher of the fair value less cost to sell vis-a-vis the value in use. Okay. So if the carrying value is higher than the recoverable value, that means that we've overstated the valuation of that cash generating unit. So what we first do is that excess, we first use it to knock off the goodwill, or let me say, we first use it to reduce the goodwill. So if the difference, even after reducing the goodwill is totally eroded, and we still have some amount that we've not deducted, what we use is now we prorate it among all the non-cash assets that we have in that particular unit. So what do I mean? Let's say, for instance, let's assume that the goodwill in that particular cash generating unit is the value is 300,000. Okay. The carrying value is $2 million, and then the recoverable amount is $1.5 million. You could see that the excess is 500, right? It is overstated by 500. So that 500, remember that the goodwill is 300. Before use it to knock off the goodwill, the 200 that is remaining, we prorate it among all the non-cash assets, right? We share it among all the non-cash assets, because remember that we need to write it down from 2 million to 1.5 million. That's what we do under US GAAP. Of course, know that the whole 500 will actually even go into our income statement as losses. Firstly, 300 as impairment charge for the goodwill impairment charge, and then the other one as also what we used to write down the remaining asset. Under US GAAP, we have what we call the two-step approach, right? What we call the recoverable test and also the loss measurement test. So think about the two tests this way. The first test is asking you, is there implication of goodwill impairments? If the answer is yes, that's when you now need to measure the level of loss. Okay, so if from step one is not showing us that there is any indication of that the goodwill is impaired, that means we don't need to bother measuring any level of loss. Okay, so is this when the first step is showing us that there's some level of losses, that is when we now go the second step to compute the loss measurements. Okay, so for step one, which I call the recoverable test, what do we do there? What we do here is that we check the carrying value of the reporting unit vis-a-vis the fair value of the reporting unit. So if the carrying value is higher than the fair value of the reporting unit, that means that impairments exist, and that means we need to proceed to the second step and measure the level of loss. But if the fair value is higher than the carrying value, that means there's no impairment, there's no point for us to measure anything. So let's now assume that we've done the tests, the carrying value is higher than the fair value, and it's showing us that there's some indication of impairments. So you can now go to the second step, which is loss measurement. And now what do we do under loss measurement? Think about the loss measurement as just we are recomputing the goodwill. And recall that under the US approach to goodwill, or the full goodwill method, remember that what we are doing is the valuation of the company vis-a-vis the fair value of the identifiable net assets. Since we are doing this at the operating segment level, we compare. What we now do is that, look, you need to recompute that. What is the carrying value of that operating segment? Sorry, yeah, reporting units. Since the reporting is under US GAAP, vis-a-vis the identifiable net assets of the reporting unit. So what you now do is that you get the implied goodwill of that particular reporting unit, and you now compare it to the carrying value of that particular goodwill. So let's assume that when you have the goodwill before, assuming you have 100,000, and when you now recompute the goodwill, what you are having is 80,000. So that means that it is actually impaired up to what? 20,000. So that 20,000 will now be the amount of level of impairment of the goodwill that we need to actually even go into the income statement as the goodwill impairment charge. Please note, under US GAAP, if your goodwill is fully written off, you don't need to prorate anything other on all the other assets in that particular reporting unit. We only have that one under what do you call it? Under IFRS. Okay. So So lastly, it's just I just have a table that shows the slight difference, the slight differences in terms of ratios and even the financial indicators between acquisition and equity method. So what do I mean? Let's assume that you acquire 60% stake in a particular company. Although it looks as if you have control, but there are some things that are showing that, look, you are not too sure if you have control. Remember that we said that the ultimate decider is not the percentage ownership, but the level of control that you have there. So we're now saying that if I've used equity method or equity or acquisition method, what will actually be the difference in terms of the financial indicators, right? So here, you will see that if you had used the acquisition method, your revenue is going to be higher, because remember that you are adding the revenue of the parent from that of the subsidiary. But remember that under the equity method, associates are not adding the revenue. In terms of operating profits, it will be higher under the acquisition method, because your equity income is not an operating profit account. It's actually a non-operating profit item. Okay, so you see that the operating profit is going to be higher under the acquisition method. Net income will be the same, right? The total asset is going to be higher, because remember that under the acquisition method, you are adding all of the assets together. But remember that under the equity method, you just have a line that shows your what? The investments in associates. Assets is going to be higher under acquisition method. Liability is going to be higher under acquisition method. Please note, for equity, if there is no non-controlling interest and you didn't issue shares in paying for that particular acquisition, the equity will be the same under the equity or shareholders' equity. It will be the same under the equity method and the acquisition method. The only reason why you have a difference between the size of the shareholders' fund will be if either you've used shares to pay for the acquisition, or you control less than 100%, meaning that you have non-controlling interests. Of course, you agree with me that the net profit margin is going to be lower under the acquisition. But remember that the profits remain the same, the net income here is the same, while the assets and liabilities are actually higher under the acquisition method. ROA and ROE will be lower under acquisition method, but please note, the only reason why ROE will be lower under acquisition method is if you have either non-controlling interest or you've paid for it with shares. Assuming you have the same size of shareholders' fund, you will notice that your ROE will be the same under either of the method. For minority interest, you don't have anything called minority interest under equity method, but you have it under acquisition. Okay. What is that with investments in corporate investments? So before we move to employee compensation, is there any question? Is there any question? Or we've addressed that? Is there any question? Anything that is not clear? Even if it's something that I don't have in my slides that is not clear, that you're struggling with. Okay, so assuming that we are all.
Can you hear me?
Good morning, sir.
Morning.
Yeah, good morning.
Yeah.
Yes.
Yeah, my name is Mary. I joined from Sokoto. Please, why is the negative goodwill add as a gain? I know why, but somebody may not really know why that happened.
Okay, thank you very much. So when you even have, there's no need for you to bother your head about it. So let's assume that if I'm acquiring, if you're having negative goodwill, so that means that what I'm paying for.
I pay less to acquire it.
Exactly. So what you've had is actually a gain. So just take it into your income statement and just move on, right? You know, the reason for the goodwill, the one that what we have as positive goodwill. Here we want to be sure that, look, you are not just doing accounting gymnastic. I want to ensure that, look, you account for it appropriately, right? For negative goodwill, we add it to your income statement as profit, and then we move on.
Then secondly, sorry, can you give me that the detail of recoverable amount? I didn't get it.
Okay. So recoverable amount is the higher of value in use and fair value less cost to sell. And what do I mean? Let me even explain it. If you have an asset, there are only two ways in which you can even get value from that asset. Either you use it or you sell it. So if I use the asset, the value that we get is what we call value in use. And what do we call value in use? It's simply you discount all the cash flows, right, that you get from using that particular asset. Okay, that's the value in use. However, if you want to sell it, is the fair value of that asset less the cost of selling it.
Cost of selling.
So you now look, which one of them is higher? Is it the value in use or the fair value less cost to sell? The one that is higher will show you the best amount that you can get, the best value you can get from recovering that particular asset. That's what we now call it recoverable amount of an asset. So the recoverable amount of an asset is the higher of the value in use vis-a-vis the fair value less cost to sell.
Thank you, sir.
You're welcome.
Yeah, I have a question.
Yes, please.
Please, under US GAAP,
Mm.
when the goodwill impairment exceeds the actual goodwill that is recorded, you mentioned we don't need to prorate. So how do we handle the rest of the amount?
Okay, cool. So let's even look at it. You notice that the way, remember that here, how do we even get the loss amount? It's simply the carrying value of that investment vis-a-vis the impaired, what do you call it? The impaired value, the implied fair value of the goodwill. If the company is doing well, there are no issues. You notice that the worst case scenario of the company is doing well is that the implied value will be zero. If the implied value of the goodwill is zero, when I'm talking about implied value, I'm talking about implied value of the goodwill. If the implied value is zero, so that means that all you just have to do is to write off that particular goodwill that we have. But if a company is now having issues, that means that the implied value of that goodwill is going to be what? Negative. Recall that the implied value of the goodwill is now saying that today, what is the valuation of this particular company or this particular operating segment, right? Vis-a-vis the fair value of the identifiable net assets. So for you to have a negative implied value of the goodwill, that means that the fair value of the identifiable net assets is higher than the what? The value of that particular company. That means that company is having issues. In that case, we need to write down part of that operating segment. But in doing that, we don't now attach it to any assets. We just deduct it in that, what do you call it, in the income statement. Is it clear?
Okay, so just deduct it from the income statement. The value of the assets remain the same, even though the assets are having issues.
Now remember that here, the problem is not with the asset of the company. The problem is the valuation of the company. You get? So for instance, let's assume that the identifiable assets and net asset is 80 million. Recall that getting that goodwill is fair value of that reporting unit vis-a-vis the fair value of the identifiable net asset. The only reason why we have a negative is if the fair value of that reporting unit is less than 80,000. So the problem is not with the assets. The problem is the valuation of that particular company. I don't know if you get it.
Yes, I get it.
Exactly.
Okay.
Fantastic.
Yeah, thanks.
Good morning.
Okay. Any other company? Any other question?
Yeah. Please, I need more explanation on how to consolidate.
So can you talk a bit, Maria, can you talk a bit louder? We're struggling to hear you.
Okay. Am I clear now?
If you can do a bit better. Are you more closer to the mic?
Can you hear me now?
Fantastic. This is way better.
Okay, I said I need more explanation on how to consolidate SPE under US GAAP.
Lovely question. Thank you for your. I forgot that one. See, for the purpose of the exam, don't let me lie to you. Just take it easy. Once we mention something is an SPV, no matter what the story that they tell you, know what you do, just consolidate it. Right? For the purpose of the exam, just consolidate it. And what does it mean that you're consolidating? It just means that you're adding the asset back to the what? Back to that, you're adding the assets of the subsidy of the SP and the liabilities back to the entity zone. The standard says that is the ultimate, please note, is the beneficiary owner, the person that benefits from that SPV that you consolidate it with. Maybe that's another thing that you need to know. One, identify the ultimate beneficiary of that SP. And the second thing is for you to do what? Just consolidate it. Is it clear?
Yeah.
Fantastic. Yeah. Okay. Any other question? Okay. Right. Let's quickly touch on employee compensation. Okay. Post-employee benefits and also share-based payment. Here we have 5 learning objectives. Said that we should be able to contrast the types of employee compensation. We should explain how share-based compensation affect the financial statement, how to forecast share-based compensation expense and share outstanding in a financial statement model and their use in valuation. Explain how post-employee benefit affect the financial statement and explain financial modeling and valuation consideration for post-employee benefit. Okay. So now, we have different types of employee compensations, right? I think we have identified 5 here. Short-term benefits, your normal salary, annual bonuses, and they're paid within 12 months. Long-term benefits are what you enjoy after serving in the company for a long while. Example is your sabbatical, right? I know some few companies, that one is more common in the academics, but some few companies have it, in which way where you have long-term paid leave, can be up to a year. And then for some companies, for you to enjoy disability benefit, you must have worked there for a long while. Of course, terminal benefits, you have severance pay, compensation, counseling, and what have you. Okay, I think I really like to, then of course you have your pension, which is your post-employment benefit, but I would love to talk a bit more about the share-based compensation. So share-based compensation is when you actually even get payments in terms of shares. And there are 4 types of them, right? Particularly in this curriculum. And it's important for you to know the differences between the 4 of them. The first one is what we call restricted stock awards. Under restricted stock award, from the grant date, you are given those shares. The only restriction is that you are not allowed to sell it. So you enjoy all the benefit associated with the shares, but you are not allowed to sell it. That's the restriction there. For restricted stock units, or what we call RSUs, for the RSUs, you are not given the shares, but let's assume that you are allocated a unit, saying that from the grant day, they are saying that, look, you guess as soon as I say that you're going to get 50,000 stocks when it invests in 3 years. So today you don't have the shares, but you are given that unit is just like a right to collect that shares in the future. So the implication of that is that under RSUs, you don't receive the dividend, but you receive the dividends under what? Restricted stock units. And this affects the valuation of RSUs because we need to deduct the dividend from the valuation of that particular RSUs. Then, of course, stock options is the right to buy shares in the future at a particular price set today. So here, what we're giving to you is an option. You still have to pay for those shares, okay? Right, in the future. Then also, let me also add it, right, so because it will help us when we are going further. For stock options, after vesting, you have a period to actually pay for it. Unlike RSUs and stock awards that you are given the stocks at the after the grant period. For stock options, you have a period to actually vote to pay for it. Then employee share ownership scheme. This one is more common for privately held companies. And like you all know, for privately held companies, you don't have access to those shares. So the employee share ownership scheme is just an opportunity for the company's employees to be able to buy the shares of the company. Because it's not listed, ideally they won't have any right to actually even buy those shares. And of course, they need to pay for it. But remember, RSUs and restricted stocks, they are actually even given to the employees free of charge. They don't pay for it. But for employee share ownership scheme, you have to pay for it. And then stock options, you also have to pay for it. But the difference between stock option and the employee share ownership scheme is that for stock options, the price is determined now, irrespective of the price after the vesting period. But for employee share ownership scheme, you pay the price at that particular period when it invests. Okay? Right. Now, in employee compensation, there are 3 important periods that are very important. The grant dates, the vesting periods, and the settlement dates. The grant date is the date that the compensation is communicated to the employee. Is the one telling you that, look, okay, employee, you are entitled to be given so amount. Then the vesting period is the period in which you earn it. Some it can be 3 years, some it can be 5 years, some it can be 2 years. While the settlement date is when the shares will be handed out to the employee, right? Of course, I'm using shares now, but for instance, if it's short-term benefits, your grant date is the day that they give you the offer letter and you start working. The vesting period is the period in which you work, and the settlement date is when you actually even actually get it. Now, the question is, how do we account for it? Broadly, how do we account for employee compensation? What we do is that the value of that employee compensation is determined on the grant date. So if it's and this is very important for valuation of share-based compensation. Is the value of the shares on the grant date. That is what we determine the employee compensation costs. And what we now do is to amortize it over the vesting period. Of course, you might need to adjust that particular amount, for instance, for those that won't meet that particular the conditions that we have. And then you now have the settlement period in which the employee have access to it. All right? Okay, so this one is just comparing the various types of the employee benefits. I won't make that time because of that. Now, let's talk a bit about the advantages and disadvantages of share-based compensation. Okay, for share-based compensation, like we all know, is when you pay your employee with shares, right? Most of the time, small companies use it to attract talent, and then some people use it as a strategy for retaining staff. However, it has some advantages and disadvantages. So let's talk about the advantages first. One, some will tell you that it aligns the interest of the management with that of the shareholders, because the shareholders are concerned about what? About the value of the shares, right? While the management, as long as they don't have shares, they won't be concerned about the value of the shares. But now that they have shares, right? They are compensated with shares. What you now see is that, look, they're also thinking about the share prices. So every decision, they try and look at what will be the implication on the share prices. Now, the other advantage is that some will tell you that it tries to moderate the principal agent's conflict. I'm sure you guys have done something like that under corporate issuance, right? Here, the principal is that the principal are the shareholders, while they tend to actually be the management staff. Okay, so since we've been able to align their interests together, you notice that a lot of them, that means that both of them are actually thinking about the same thing. They are worried about the same thing. And what you see that their action tends to what? Tends to kind of align. That's another advantage. Now, what organizations typically also do is to have multiple vesting periods. So meaning that in year one, you might be given some stock option that will vest in the next 5 years. Year three, you might be given another 5-year stock option, such that by the time the first one vests, you still have another one, right? That is still going through the vesting period. So at any point in time, what they've done is to be able to align your interest to the shareholders, but to also ensure that they actually improve staff retention. Because before you leave, you'll be thinking that, because if you leave during that particular period, you won't meet the condition for that particular stocks, and then you won't be able to get that share-based compensation. Okay, right? So you actually even think twice before resigning, right? And some also argue that for share-based compensation, it has no cash outflow for that particular company, and which help the company to preserve that liquidity. And that is very important for very small companies that are just starting out. They will tell you that, look, okay, I might not be able to pay you big salary, but what I will do is that I will give you share-based compensation. The next 5 years, if you work with us and help us grow this company, you will own X percentage of that particular company. Now let's talk about the disadvantages, right? The first one is that some people will tell you that, look, employees, no matter what they do, they have little control over the share price of a particular company. So meaning that you can be doing anything. What determines the share price is not only even profitability. It might even be something outside the control of that particular employee. And some will now argue that, look, using share-based compensation methodology is like compensating employees for what they don't even deserve or what they don't actually even have control on. And some will also argue that if you have share-based compensation, it can actually result in the management team taking what we call suboptimal risk, meaning that they might want to actually even take a decision in which it can affect the profitability in the short term, but in the long run will actually even help the business positively. So it could be that it will affect the profitability of the business in the next 3 years, But after the next 4 years, the business will be making profits. Assuming that they are using share-based compensation and the person has stock awards, maybe the management can be thinking that, look, that means that my dividend will actually even reduce during this particular period. And the management team can just say, no, don't let's take that decision. Although it's good for the company, but since it will actually even affect us, our return from the business, they won't take that one, which ultimately might hurt the business in the long run. The other disadvantage is that it actually results in the concentration of the wealth allocation of the employees. When you get to level 3, you're going to talk about private wealth management. As something like we all know in finance is that, look, you need to diversify your investments as much as possible. So meaning that if you are working in an organization, right, a significant proportion of your wealth is already concentrated in that particular organization. Assuming you now even have stock awards and share-based compensation, that means if anything goes down, happen to a particular company, you actually be in trouble. I remember somebody that used to work in Enron, and when Enron went down, his share-based compensation, even the pension plan that he actually chose, invested a lot in Enron. So he lost a significant proportion of his wealth just because that particular company went down. And then the last disadvantage is that although there's no cash outflow, there are also some opportunity cost lost. So for instance, the shares that were given to the employee, if they've been sold to shareholders or to potential investors, the company will have actually realized some cash inflow. And also, what some companies typically do is that to ensure that you moderate the number of shares that you have out there, they buy it back. So what do I mean? So they can say that, look, 80% of the shares that were given to employees or for share-based compensation, will buy it on the open market, just to ensure that we control the number of shares out there. And of course, if you are buying the shares of the company, of course, although it will be treasury stock, you know that there's already a cash outflow because you are actually even expending from. Okay, now, so let's talk a bit about employee cost of share-based compensation. How do we pay for it? Recall that I told you that, look, 3 important dates: the grant date, the vesting period, and the settlement date. The grant date, like I said, is the day in which that benefit is communicated to the employee, and the employee was attest to actually receiving it. And please note, what we do is to now get the valuation of those shares on that grant date. Of course, note that for the vesting periods, it doesn't mean that there are some conditions for you to actually even get those shares, right, on the settlement dates. Some, we have what we call service condition. Some can tell you that you must be in the employment of that particular company all through that particular period. That's what we call service condition. There are some share-based compensation that also have what we call performance condition. Some can tell you that for you to enjoy the share-based compensation, your EPS of the company must not be below a particular amount. The ROE and ROE of the company must not be below a particular amount. Those are what we call performance condition. Now, what we do is that, look, every period we adjust the value of the share-based compensation by those conditions. So what do I mean? Let's assume that we've allocated share-based compensation to 20 employees on the grant dates. And after a year, 5 of them left. So that means that we need to adjust the expense, because those 5 that left, they will not actually do what? They will not be entitled to that particular distance. So you don't need to expense that. Then secondly, assuming we now realize that, look, the performance conditions are not met, definitely we now know that, look, we need to also adjust the share-based compensation. So let me first take a step backward. The reason why we are expensing the value of those shares is that, look, is the company that implicitly is paying for those shares, right? And if you not met those conditions, you'll not be giving those shares, and then what happens? There's no point for the company to actually pay for it, all doing this. Okay? And then, so of course, we need to use the revised amount periodically. Now, on the settlement date, the shares will be issued to the employees. Now, let's talk a bit more about stock options. Recall that we said that your stock option is simply, you are given the right to the employee to buy the company's shares at a particular point in future. However, using the price determined on the grant date. So most of the time, those shares are actually in the money when those stock options are actually issued. Okay. Now, please note that the employees will have to pay for it on the settlement date. But like I also mentioned to you earlier, for stock options, we don't have what we call settlement dates. We have settlement period. So meaning that they can say that the settlement day, from the settlement day, you have 3 years to actually take up that option. And if you don't take it after 3 years, that stock option will expire. Note that in now determining the employee compensation, what we are giving the employee free of charge that the company will pay for is an option. So unlike the stock award in which we are trying to get the value of the shares and we are paying for it implicitly, here we are implicitly paying for the stock option. Is the option that we are paying for. Okay, right. And that means that the valuation here is the stock option that we are valuing. And of course, I'm sure you've done some valuation of options, right, in other derivatives. So that means that the organization must have a model for determining the stock option, right? So you can use either the Blasco model, the binomial model. You can use any model. However, there are some conditions that must be met, right? The valuation model must be consistent with fair value measurement requirements. It must be based on the established principle of financial economic theory. It must reflect all substance characteristics of the award. And then also in the financial statement, all the assumptions that are gone into the stock option valuation must be stated. Things like the volatility, the estimated life, the risk-free rate, and the dividend yield. All those ones must be stated in the financial statement. And please note that of all these assumptions, the most volatile is the what? Is the valuation, is the volatility assumption, while the most objective is your what? Is the exercise price. Now, note something, that whenever the share price at the settlement date, or let's say all through the settlement period, if the share price is below the grant price, what you see is that, look, the stock will actually even expire, will be out of the money. It will expire. People won't take it up. Because if I have an employee, you are giving me an option to buy a share at $50. But the market price is 30. I would rather go to the market and actually vote and go and buy it. Right? The only condition where the employee will take up the stock option is if the strike price or the strike price of that particular option, which is simply the share price in which they're allowed to pay for the price, is way below the market price all through the settlement period. Now, let's refer our mind back to level 1. You know, under level 1, when we're doing level 1, we did tax, right? Income taxes. Now, share-based payments at times have tax implication. So what do I mean? Because remember that we said that the share-based compensation, what we primarily use is the share price on the grant date. That's what determines what the share-based compensation. However, for the tax authority, remember that the tax authority doesn't like provision or what have you. So if we wait until the settlement date to determine the price that will be used in computing the share-based compensation. So while you are using the share price on the grant date, if we use the share price on the settlement date. And don't forget that there's the vesting period in which you've been expensing that particular share-based compensation. The tax man won't do that until the settlement dates. That's the only time when you have the share-based compensation in the tax report. So the first implication of it is that you're going to have DTA, deferred tax asset. I'm sure you still remember that one from level 1, right? Now, the thing also is that whenever the share price on the grant date that we've used in computing our own share-based compensation is different from the share price at the settlement date, it might result into the taxes that we have in the income statement and the taxes that we have on the on the tax report, meaning that we can actually have the paying higher taxes or lower taxes. So what do I mean? So meaning that if the share price on the exercise date or the settlement date, if it's higher than the share price on the grant date, that means that the amount that will be deducted as share-based expense is going to be higher in the what? In the tax report than what we have in the income statement. And of course, that one will result into what we call excess tax benefits or tax windfall. Because that means that the taxable income will be lower than the what? Than the profit, will be lower than the profit before tax. Okay? However, if the share price on the settlement date is way lower than that what we have on the grant date, that means that, look, we have a tax shortfall. So that means the provision that we have on the income statement, the amount that we have to pay will actually even be higher, because that means that the amount that will be deducted in this tax report is lower than what was deducted in the income statement. And that will result into what we call a tax shortfall. Okay, so the tax windfall or the excess tax benefit is like an additional income to us, while the tax shortfall is the amount that we need to also pay back. Now, under IFRS, please note, under IFRS, your tax windfall or the tax shortfall, they are adjusted directly in equity. Chinaza.
Please, can you go over the tax windfall and tax shortfall again in terms of the taxation expense?
Okay, that's fine. Now, remember that here, what we are talking about here is an expense in the account. So remember that if we have, let's assume that the unit remains the same. Assuming that the share price on the grant date is higher, okay, than what we have on the settlement date. So that means the expense that we have on the income statement is going to be higher compared to what you have on the what? On the, what you have on the tax reports. So in that case, the profit before tax that we use to compute this thing is going to actually be lower, because you are deducting something more compared to what you have on the tax reports. So the implication is that what you have in the income statement, remember that what you have in your income statement is like a provision. So the provision that you've made will be higher. And remember, if you remember from level 1, we learned that the amount that you pay at taxes is not what you have in the income statement, is what you have on the tax reports, prepared at least based on the principles of the tax man. So if what I have on the tax report is lower, because what I've deducted is what I have on the tax report is higher because what I've deducted is lower, you notice that I will end up paying what? Lower amount of tax compared to what I've provided for. And that will give me like a benefit, or what we call excess tax benefit or tax windfall. But if, on the other hand, the share price on the settlement date is lower compared to that of the grant date, remember that means on the grant date, what I have there, I've used a higher amount. I've deducted something higher. The profit before tax is lower. I've made lower provision compared to what we have on the what? On the tax report. So that means that the amount that they have on the tax report, it will be way higher than the provisions that are made. So that means I have a shortfall in terms of the provision that I've made for that tax payment. In that case, that means that I need to pay something more than what I've provided for. And that's what we call a tax shortfall. And a tax shortfall is not simply that, look, means that, look, I'm going to pay more than what I've provided for. While the windfall says that, look, what I will pay is lower than what I've actually provided for. After I'm coming. But Chinaza, is it fine? Is it clearer now?
Yes, but I kind of get confused when you say tax deduction and then you say tax expense. Like it kind of, so like I'm trying as much as possible not to cram it, because obviously I understand there's a gain when you have the settlement price is higher, right? There's a gain. IFRS put it in so, but what I'm confused about is when you're talking about the tax deduction and then you're talking about the tax expense.
So now, when I'm talking about deduction, that for instance, you know that in the income statement, if you remember, okay, let's talk about the income statement. You have your revenue, you have your expenses, you need to deduct your expenses to now get your profit before tax, right? Under your tax reports, you have your taxable income, less taxable expense. You now get your what? Allowable income, and then you can get your what? Taxable income. I mean, the net, let's call it net taxable income. Right? I know that is not fully right. But remember, when I'm talking about the expense, I'm talking about the expense that you deduct from your income to now get your profit before tax. Or the allowable expense that you deduct from your allowable income to get your what? Your taxable income. So remember that this your employee compensation is an expense item on the income statements. So that means that if I'm deducting more, that means my taxable income is going to give me something a bit worse, lower. Chinaza, is it clear now?
Oh, okay, yeah.
Right?
Yeah.
So
Yeah.
because this share-based compensation is actually an expense. Is it clear?
Yeah,
Okay.
that makes sense.
Yeah. Alfred.
All right, thank you so much, Ayokunle. My own question is about the excess benefit and tax windfall and tax shortfall. Are they the same or different from deferred tax assets or liabilities, in the sense that, deferred tax assets and liabilities, they reverse themselves over time? Is this permanent or is it the same? Is there a difference? I just don't have clarity on that.
Brilliant question, Alfred. So think about it this way. Remember that your DTA are meant to reverse in future. So let's assume that what you have is as DTA is what? 200. But when they are now reversing, right? Know that when they reverse, it will actually be what? A net this thing there. So assuming that when they are now reversing, is even 350 that is reversing. So that means that you have a gain of already what? 150. 200 have already reversed. But what is that telling you? That you've not provided, what you provided is this thing there. The benefit is actually much more than that. So this tax windfall or tax shortfall is what now happen after there is that reversal. If the benefit is more than what we provided for, what we have is what? A tax windfall. But if it's lower, it's now what we call a tax shortfall. This is telling us what happened on, if you can call it a settlement date or reversal date, if you can call it that.
Okay.
You get?
Thanks so much.
Much. Right. So under IFRS, the tax windfall or tax shortfall is recognized directly in what? Equity, because IFRS sees it as transaction between the shareholders. But under US GAAP, this is adjusted in your income tax expense. Okay? And the implication of that is that it affects your effective tax rates. Remember the effective tax rate, we learned that one in level 1. So it can make your effective tax rates to be volatile if you are using what? If you are using US GAAP. Okay? Now, another implication of share-based compensation has to do with the outstanding shares, both the basic outstanding shares and the diluted outstanding shares. Because the implication of share-based compensation is that if you are not buying your shares back in the open market, although a company, you've not done IPOs, you've not done rights issue, you've not done private placement or even public placements, it might mean that your number of shares will actually even be increasing, right? By the time of course, when those shares are settled for your basic outstanding shares. Then assuming that you're even looking at your diluted outstanding shares, your diluted outstanding shares will actually even be increasing, even if those ones have not even vested, because you have what? Share-based compensation. So that means that the share-based compensation has a way of impacting both our basic outstanding shares and our diluted outstanding shares, particularly when we are using the treasury stock method. So how does it affect it? So we also say that our diluted outstanding shares is your basic outstanding shares plus the number of shares that will be converted, right? Using the stock awards, less the assumed repurchase shares. I'm sure you have an idea of level 1 where we talk about some. And how do you determine the repurchase shares? We always assume that the repurchase share is the proceeds that we get from the conversion of those shares or those stock awards divided by the average share price during that particular period. And then what's the assumed proceeds from the stock award is basically their cash proceeds from the exercise, assuming that is equity stock ownership scheme, or assuming is share options. No, they have to pay for it. So the cash that we get is simply what, or the one that we get, or we're assuming to get, because remember that we're talking about diluted shares. We're talking about the ones that haven't vested, right? That's the cash proceeds. And then the average unrecognized share-based compensation. So meaning that assuming we have stock options, the one that we've not expensed, and even when we even have share stock awards, the one that haven't vested, the amount that we've not even expensed during the vesting period, right? Those are the things that we had together to get the assumed profits. And don't forget the assumed reported share is the assumed profits divided by the average share price for the period. Okay. Let's quickly talk about post-employee benefits, right? So your post-employment benefits, we can say that there are two types. We can say there is a cash element, which is the pension that the employee will enjoy at retirement. And there is also the non-cash benefits, right? For instance, because some companies can say that there will be medical care. Some can even have subsidized travels or anything for their what? Retired staff. That one is the non-cash benefits. Okay. Let's really talk a bit about the pension. Like we all know, we have two types of pension: the defined contribution plan and the defined benefits plan. But defined benefits plan, like we all know, is determined by here the employer just make a contribution into the employee's selected pension account. However, so one of the most important things here that I want you to note, please don't forget that, is that look, under the defined contribution plan, the employee bears the investment risk and the what? Actuarial risk. Please note that one. Don't forget that. Okay? So the investment risk and the actuarial risk, the employee bear those ones. Okay? However, okay, so now let's talk a bit about the reporting. Reporting is very simple. The amount that goes into the income statement is the amount that is expensed during that period. And oftentimes, the pension expense and the contribution are simply the same thing under the defined contribution plan. Okay? However, for the balance sheet also, it's simply the same thing. Most of the time, you don't even have any liability on the balance sheet, except you have some pension contribution that you've not made at the year end. And most of the time, it's typically very, very small. Okay? And for the cash flow, is the contribution that just goes into the cash flow statement for the period. The one that the accounting can be a bit complex is what we call defined benefits plan. Like we all know, under defined benefit plan, you pay a particular amount to an employee from retirement until death. It can be structured so that the lump sum will be paid as retirement, and some can be like you pay in a periodic amount until death. So the amount that the employee is entitled to, of course, we all know is based on a formula, right? And oftentimes, what determines the amount, right? At times, most importantly, is the final year of salary, final salary that the employee had, and the number of service years. Now, the big question is, do we know when the person will retire? What will be the final salary? We don't know that. How many years will he work for us? We also don't know that. And that is why we need to bring in actuaries to help us with those computations. And of course, we all know that defined benefits plan also have a vesting period, okay, in which you must work with the company before you end that also. Okay, so please note here, under defined benefit plan, the employer bears the actuarial risk and the what? Investment risk. Okay. Now, please note that to ensure that the employer have enough assets to meet up the obligations, we always say that, look, right, the employer is mandated to actually set aside some assets in trusts, and that asset is bankruptcy remote. You need to set up a trust where you have some assets that is actually even actually even set aside. Okay, so what you have is that the minimum funding of that particular asset is actually even varies from country to country. And like I said, it must be bankruptcy so that if anything happens to that particular employer, those funds are still available to meet the pension expenses. Now, you've seen that, of course, you've read the curriculum, you'll have seen that a lot of companies, because of the issues that they're having, are moving to the defined contribution plan. I'm sure you've read the case study of General Electric, right? Showing the challenges that companies are having to define with defined benefits plan. Because of that, we now have what we call closed plans and frozen plan. Please note that one. There are some slight differences between the two of them. For closed plans, it just means that you are not bringing in new employees, right? Those that are there, they are still earning all their benefits, and the amount that they are entitled to in future will actually be increasing. For frozen plan, here is not only that you are not even bringing in new people. Those people that are already there, the benefits are already frozen. So meaning that there won't be the amount that they're going to get, irrespective of when they are taking the funds, either now or in future, is already determined today. It will not grow. It will not increase. That's the slight difference between a closed plan and a frozen plan. Please take note of it also. Now, in terms of reporting for defined benefits plan, now remember that I mentioned the non-cash post-employment benefits, or we call it other pension.
Apologies.
Shile, go ahead.
Good morning. Apologies.
Morning,
Could you please go over the closed and frozen again?
Okay. So, if we say you have a closed plan, it means that you are not any new employee now. They will just be doing the defined contribution. Nobody can join that plan. For those that are not bringing new people into that particular plan, the organization said that, look, there's no more defined benefit plan for new employees. Those that are there, they're already there. However, remember that your benefits under your defined benefits plan is a function of your final salary and also the number of service years. So that means that although the plan is already closed, for every new year that you worked, your entitlement is also what? Increasing. So that means that even your final salary will be based on the year that you are retiring. That's for a closed plan. For a frozen plan, not only are we bringing in no new people, we are now saying that for even those that are even there, even if you like retire in the next 20 years, the benefit that you have is the same thing that was completed today. So meaning that irrespective of if you work with us for 10 years, if you work 20 more years, what we're going to use in computing is what? 10 years that are today, because it's already what? Frozen. We will not use your final year salary. Is your salary as at what? Today. Because that plan is frozen. It will not grow in terms of what? The benefits that we owe to the employees when they retire. But for closed plan, the benefits will still be increasing. It's just that we're not bringing in new people. Sheila, is it clear now?
Yes, thank you.
Yeah, you're welcome. Okay. Right. So the non-cash pension, and we account for it the same way we account for defined benefits plan. So how do we account for defined benefits plan? So let's first talk about the balance sheet. Okay. Now, recall that we said that you need, as a company, you need to set aside some assets, right? So the first thing we do is that those assets that have been set aside, right? What we do is that we get the fair value of those assets, right? Next, we now get what is the present value of the pension obligation. So what is the present value of all the obligation that we owe to the employee? Of course, the payments will be made in future when they are retiring. But as of today, what is the present value of those obligations? We need to get it. I'm sure we also know that, please, right? That's what you have is the, I'm sure the next question will now be, how do we determine the present value? Of course, we all know that what we use as the discount rate is the yield on investment grade corporate bonds with similar currency and also with similar duration, right? However, in markets where you don't really have an active corporate debt market, you can use the yield on the treasury security, on the treasury bond with similar currency, similar maturity, similar duration, right? And things like actuarial assumptions, how long the person will live, all those ones, we don't need to bother ourselves about that. We just get an actuary to actually even do that for us. So please note, on the balance sheet, what you have is what we record is the net funding status for each plan. Okay, so for a plan, we have assets, because remember that you have an asset, you have some set of assets that you set aside. We won't record both the asset and the obligation. What we have is the net amount. So which is simply the fair value of the planned asset less the present value of the pension obligation. So in that case, you can have what we call an overfunded pension plan, or you can have an underfunded pension plan. So when you have an overfunded pension plan, it means that the fair value of the planned asset is higher than the what? The present value of the pension obligation. In that case, for that particular plan, what we have is, we record is a net pension asset. However, when we have an underfunded pension plan, what that more means is that the present value of the pension obligation is higher than the what? The fair value of the pension assets. And in that case, we have a net pension liability recorded on the financial statements. So that means that for a particular plan, you can have either just a net pension asset or a net pension liability. Having said that, please note, it's possible for you to see a financial statement for you to now have net pension assets, net pension liability. What it means is that they have more than one plan. Recall that we said that all the other non-pension employee benefits, right, that those free medical care and all, they need to also value them separately. So they might have that one. So that means that is why they have, it doesn't mean that that's why they have both the net pension asset and net pension liability. One is for a plan, or the other one is for the other plan. It doesn't mean that it's for the same plan. Okay? So because we can't net the pension status of both plans. Now, for the income statement, let's talk about what goes into the income statement. There's a slight difference between what goes into income statement under IFRS. Not enough, they are the same thing actually, but it's just the classification that is different under IFRS vis-a-vis the US GAAP. Okay? Now, please note that under both of them, what goes into the pension, into the statement of comprehensive income is the, should I call it, the net changes in the funding status for year to year. So that means that, assuming that last year we have an underfunded plan of $100 million. This year we have an underfunded plan of $120 million. So that difference is 20. That is what we see in the income statements. Okay. However, please note the contribution to the plan assets, we don't record it in the income statement. We see that impact in the what? In the cash flow statements. Okay. So having said that, let's talk about the classification of the components, right? That goes into the statement of comprehensive income. Under IFRS, there are three things that goes into the statement of comprehensive income. The first one is the service costs. Under service costs, we have the past service costs and the current service costs. The past service cost, so let's first talk about the current service cost. The current service cost is as you are working for each year, you are earning more, Abi. So the additional amount that you are earning in a year, that's the current service cost. Then past service cost is the adjustments made to the plan that affects the past years you worked. For instance, assuming that we were saying that before, what you earn is 0.5% of your final year service multiplied by the number of years that you worked. Assuming that they now want to change the plan to 0.75% and they want to apply it retroactively. So that adjustment that we made for those past years that you worked, that's what we call your past service cost. Okay? Next you have your net interest income or expense. And how do you get that one? That one will actually be your what? The discount rate, which is, remember that discount rate that we use, multiplied by the net funding status. So that means that if you have an overfunded funding plan, you have an net interest income, or if you have an underfunded pension plan, what do you have is what will be a net interest expense. Please note, this net interest income or expense goes into your what? Finance costs, right? While the service cost goes into your OPEX. The third thing is what we call the remeasurements. And your remeasurements are two in nature. We have what we call the actuarial gain or losses, what are changes, gain or losses attributable to changes in your, should I call it actuarial assumptions in terms of mortality rates, employee turnover, what have you. Okay? And also the actual return over the planned assets and the return based on the what? The return computed or based on the discount rate. Recall that in computing the net interest income or the net interest expense, we use the yield, on either the corporate bonds, if you have a very active corporate bond market, or the one on the treasury one. So that difference between the actual return and the planned return form part of your remeasurement. However, please note this one today. Please note, remeasurement stays in your OCI under IFRS forever and ever. It does not enter the income statement. Okay? It stayed in your comprehensive income, your OCI. That's that one for IFRS. For US GAAP, substance over form is the same thing that goes in the statement of comprehensive income. It is just the classification that is different. So now US GAAP, you have the current service cost, which I've explained before. You have your interest income, and your interest income is the what? The present value of your pension obligation multiplied by the what? The discount rate. Is simply the unwinding of the discounts. Okay? While the expected return on planned assets is the expected return multiplied by the what? By the actual planned assets. Please note, your current service cost goes into your OPEX, interest income, and expected return on planned asset goes into your what? Your finance costs. Then you also have amortization of past service costs. Look, I think I've explained what service cost is. So when you compute service cost under US GAAP, right, you don't take it only to the statement of comprehensive income like we had under IFRS. What we do is that we actually amortize it over the average employee years, or the number of years that in which the employee will work for us. Okay. Then amortization of net gains or losses. So actuarial gain or losses, right? What we do is that, of course, we have explained what actuarial gain and losses means. It goes into your OCI. You can either, now you have to choose under US GAAP. You can either take it to the income statement if you like, or you can take it into your OCI and gradually be expensing it into the income statement using what we call the corridor approach. And what's the corridor approach? It's simply saying that the cumulative actuarial gain and losses, you compute it, okay, right? You get 10% of the, you could also get 10% of the opening planned assets, or opening, you get 10% of the opening planned assets, you get a 10% of your opening pension obligation. The higher of it, you compare with the cumulative actuarial gain or losses. That difference, if the cumulative actuarial gain or losses is higher, that difference, you amortize it into the income statement over the remaining service years. The one that is below the 10% of the opening plan asset or the opening pension liability, that one stays in your what? In your OTI. I think I've mentioned to you that the cash flow statement, the only thing that goes there is the contribution to the what? Okay. So any question before we quickly talk about analyzing financial institution? Any question?
Yes, please. Can you go over the corridor approach again? Yes.
Okay. Now, for the corridor approach, what do we do? Okay. Of course, you have your cumulative actual gain or losses. You compute it down. You keep it somewhere. Now, what you can now do is that check your opening pension, opening plan assets, and your opening pension liability. Which one is higher out of them? The one that is higher, let's assume that is the planned asset that is higher. Get 10% of that opening planned assets. Right? So that 10% that you've gotten, the value of it, now compare it to the cumulative actuarial gain or losses. So let's assume that here, this year, the cumulative actuarial gain or losses is $30 million. And the 10% of the opening planned assets, which is higher than that of the pension liability, let's assume that the 10% of it is, let's say, to make it easy, $10 million. You know that difference is now what? $20 million. So that $20 million, we gradually expense it into the income statement over the remaining service years. Assuming that the person will work with us for the next 5 years. So we can now expense this 20 over the next 5 years. Chinasa, is it clear?
Yes.
Okay, fantastic. Any other question? Right. So let's quickly look at analyzing financial institution. Okay. Because of time, I won't go through the learning outcomes, right? We have less than 5 minutes if I'm correct, right? And then the first LOS is telling us that why are financial institutions different from other companies? I think there are two differences. One, the first difference is that financial institutions deal with financial assets and liabilities, right? Unlike a typical corporate, that's what the bulk of what they deal with are physical, tangible assets. And what you also notice that financial assets, the risk associated with financial assets are quite different from the risk associated with what? With those tangible assets. And for financial asset, the major risk associated with this will be credit risk, liquidity risk, and what? And market risk. And what we've noticed is that financial institutions, they've grown so big and they've also gone so integral to a well-functioning economy. Okay? Although that one has helped to develop and to accelerate the growth of the global economy at different entities economy, right? What we see is that it is also oh, Lawrence, I'm just seeing your comments on equity method. Okay, what I will do is that, Lawrence, I will drop my number after the class, so we can also talk after the class if it's something that I'm just saying your question now. Yeah. So because they are although they've helped to grow the global economy, but you see that they've also created what we call systemic risk. And what systemic risk? Systemic risk is just a risk that, look, if the portion of the financial assets of financial system is not working, right? For instance, assuming that the bank is having issues, the whole financial system might be dragged down, and the whole economy can also be dragged down. Similar to that is what we call the contagion risk, which is the risk that, look, right? Even if you have a problem with the financial system, in the country, it can actually even expand to other countries, right? And remember the 2008 financial crisis. Okay, right. So in analyzing financial institution, particularly banks, let's first start with banks, right? There are some factors. We use the CAMELS approach. We stand for capital adequacy, asset quality, management capability, earning sufficiency, and also sensitivity to market risk, right? Are the things that you look at when you're analyzing banks. Although this CAMELS approach is very good, what we've noticed is that it has some downsides. It's not comprehensive enough. That's why we also look at some other things such as the government support, mission of the bank, the corporate culture, the market share, right? Off-balance sheet items, segment reporting, currency exposure, risk factors, and also the level of disclosure by that particular bank. Okay. Now, for insurance companies, right? Of course, we all know what insurance companies do. What they do is to underwrite risk, okay? And then they earn return, they earn premium, and also investment income. In analyzing insurance company, we look at various things such as earnings profile, liquid investment return, level of capitalization, and business profile and earnings. But what I will say there is this. The most important that you need to also notice that, please note that for the life companies, their level of risk is relatively measurable. Unlike the non-life or what we call property and casualty insurance, in which the claims can be volatile. So what you see is that the level of capitalization needed by P&C insurance companies is higher compared to that of the life company. I think some of the expense ratios, but because of time, I won't be able to go over them. Okay. So I think do I have a minute to just take some questions? Or my time is up?
Okay, we'll give you 2 minutes. 2 minutes to take questions. Shegun is already in the room.
Oh, sorry. Sorry, I'm sorry, Owazo. So any question? Or let me put it this way. I've dropped my number on the chat room and also dropped my email address also. In case you have any question, maybe what we've discussed today and what we've not discussed today, please feel free to reach out to me. Oh, sorry, I think I've dropped it. Okay, I'm dropping. I send a message to you directly. Wait, can you help me? Can you help me send it to the general
post
room?
it. I will do that now. I'll do that.
Okay. Thank you very much. Thank you very much, everybody. Thank you.
Thank you, welcome, BY. Excellent. Yeah, how are you?
Thank you.
All right.
Thank you, sir.
Thank you. Bye.
So the next class is corporate insurance, and Shegun Owadokun is taking the class. Is already him. All the best, guys.
Yeah. Thank you, Bukola.
Kindly mute yourself, Nkiru. Kindly mute yourself.
So, good morning, class. Can you confirm you can hear me?
Can hear you,
Yes,
boss.
good morning,
Yes,
sir. We
we
can
can.
hear
Good
Yes,
you.
we
morning,
can.
sir.
All right, good morning. It's good to be here. So, my name is Olusegun Wadokun. I'll be taking you through corporate issues, what used to be known as corporate finance. And interesting thing I always say about corporate finance is the fact that corporate issue, as you might call it, is that it's actually very straightforward. It's cut across almost all the other elements of readings you have in the curriculum, cut across financial statement analysis, knowledge of financial statement analysis, equity investment. So nothing really different. And again, I think CFA Institute has even simplified the corporate issuer module in such a way that is now a bit, at least it's a bit easier because they've actually removed capital budgeting, capital structure. Yeah, they replace it with, what's it called? So these are 4 modules. So now they introduce a cost of capital, which used to be part of a level 1 curriculum. I'm very sure you've already done cost of capital in level 1. So it's not advanced here, just ignore. It's nothing advanced really about this. So it just, so don't be scared. Now, the last reading, corporate restructuring, used to be mergers and acquisitions. So they're renaming corporate restructuring. So there are still some element of merger acquisitions, but expanded the scope. So I'll just quickly go through the modules. I only have 1 hour, so I'll be a magician to try and go through this in 1 hour. And if time permits, I have some teasers, some questions, practice questions that we can just go to about 10 of them, go through in the course of the program. So these are the LOS. I'll not go to the LOS. So now we have the first thing I'll look at financial statement effect. The first you didn't talk about analysis of a dividend, and you already understand what dividend mean and different types of dividend. I won't bore you with that. So what is more important for us to note here, which are the areas that are usually sometimes tested in the exam around here, is what are the financial effects of whether you pay dividend, you do stock dividend. Stock dividend is what we call bonus issue in Nigeria. So this diagram, just to give you a sense, if you pay dividend, so you affect cash, so there is decrease in cash, right? And cash is reduced, so meaning asset is reduced. So the implication on liquidity ratio will be that what? Liquidity ratios are some example with current ratio, which is like current asset over current liability. Because the asset, which is the numerator, has reduced, so what happened on liquidity ratio? There is a drop, which is the arrow down here. So what I'm giving you a sense of how you don't need to cram some of these things. If you just have intuitively, you can figure it out in the exam, and very straightforward. For leverage ratios, now cash also reduced. There's no change in liability. So meaning that you need cash to pay your liabilities. So if cash has reduced, so that means the leverage ratios will be elevated, so will increase. Same goes for profitability ratios. So for profitability ratio, it will go up. For example, ROE. So there is no impact on so there is a decrease in what is it called, equity, which is your numerator, so denominator in this case. So that means profitability ratio will go up. On the other hand, for stock dividend, there is no impact. Mark that, no impact on any of the financial ratios. And why is that so? So when you do a stock dividend, no change in asset, but there is no change in equity. The only change in equity is compensating, in the sense that what you are just doing when you are doing stock dividend, you are redistributing capital. You are moving computer capital, you are moving your retain earning will drop and your computer capital will go up. So because you are using retain earning to actually do stock dividend. So at the end of the day, no impact on equity. And for that reason, there is no impact on any of the financial issues. That is very important for us to note. So then we look at dividend theories. So now, what you see here is that there are some theories. If you call in your capital structure, I think you did that in level 1. There is what we call the Miller and Modigliani theory that tell you that regardless of how you finance your business, it doesn't have impact on company value. Similar theories also apply in dividend. So, and that first theory is what we call the dividends irrelevance theory. And that was also provided by Miller and Modigliani. And what is the essence of what they are saying here? That under perfect capital market assumptions, a dividend policy, if MDB level doesn't have impact on company value or valuation, which is why dividend policy doesn't matter. Because they are saying that in the perfect market where there are no transaction costs, no taxes, and there is no information asymmetry. So what happens is that there is no value, because if you need to pay dividend, what you can do is that the individual shareholder can actually make dividend on their own, and that's what they call homemade dividend. That's one concept you need to remember under the dividend relevance theory. On the other hand, there is what we call the burn in the hand argument theory, and that is saying that because cash dividends are more certain than capital gains, because if you are not paying dividend, the only way investors can realize value is to actually sell some of their portion of their investment in the company, and that will be subjected to capital gains, right? So what we are saying here is that because cash dividend is something more certain than stock appreciation can be volatile. So companies that pay dividend usually tend to have lower cost of equity. And you know, in your valuation, if you have a lower cost of equity, the impact on your valuation is that the value of the company should go up, all things being equal, because the denominator has reduced. So as a result, value should increase. And that is what we mean by the bird in the hand is water in the bush. That is where that argument comes about. Then there is the third one that talks about the tax argument. And what this is saying essentially is that in most tax jurisdictions, you realize that the tax rate for dividends and tax rate for capital gains are different. And most times, sometimes you realize that the tax gain or dividend are lower than the capital gain maybe is lower than dividend payment. Companies will prefer to pay what? To do share repurchase as opposed to cash dividend, because it's lower from the perspective of the investor. And that is why we're saying that this one also can impact valuation, and it will go in preference for either dividend payment or capital gains. And under this dividend policy do matter. So the last part is the other issues around signaling. And signaling essentially is saying that due to information asymmetry, remember the Miller and Modigliani theory, there is information asymmetry between the owners of the business, shareholders, and management. So dividend payment tend to signal, convey information to the market and to investors. So, and there are two categories of information that can be conveyed. That is either positive signal or negative signal. So what you find that if companies decide to increase their dividend, then definitely is send positive signal to the market, which might impact valuation of the company. On the other hand, if a company that has been paying dividend decide to say they are not paying dividend in a particular year, or decide to cut dividend significantly, it can also convey negative signal, which can adversely also impact the value of the company. So that is what signaling is about. Then related to that is agency cost effect. Agency is also because of information asymmetry. So you realize that companies and that is based on agency free cash flow hypothesis, which is saying that if you have a company that have excess surplus cash, this dividend payment can discipline management to actually act in the interest of the shareholders. So it reduces agency cost, and because it reduces agency cost by paying dividend to your shareholders when you don't have investment opportunities, then agency cost effect can actually be beneficial from the perspective of the company. So those are just the summaries of this policy. Now let's go to factors that affect dividend payment. The first one is investment opportunities, which is related to what I just talked about, surplus cash. So if there are a lot of investment opportunities means that the investment opportunity will give you your weighted average cost of capital. What you are going to get from that investment return is going to be greater than your weighted average cost of capital. So, or what you call the net positive NPV projects. So it's better for you to conserve your cash and reinvest, because it will be in the interest of the company in the long run. So more investment opportunity for the company, the companies tend to pay less dividend. So there is an inverse relationship between dividend payment and investment opportunity, negative relationship. Then for expected volatility of earnings, future earnings as well. If the company's earnings are very volatile, that is company that operate in cyclical industry, for example, they tend to be conservative in their dividend payment as well. So there is also a negative relationship between volatility of future earnings and dividend payment. The same also applies for financial flexibility. If a company desired financial flexibility in the sense that they want to be able to take advantage of any market opportunities at any point in time, they tend to also be very conservative in their dividend payment. And there is also a negative relationship between dividend payment and financial flexibility. The tax consideration is in line with what we discussed under tax argument. So tax consideration, if capital gain tax are lower than dividend tax, then you realize that companies tend to favor share repurchases as opposed to cash dividend. Flotation cost is the cost of issuing new securities in the market, either equity security or debt securities. So if flotation costs are going to be very expressively high, and that means company will prefer to conserve cash and use it to invest into the concept of going to pay dividend, and you need to now go to the market to issue new debt or equity at a very high cost. And this is what the pecking order theory also suggests. You remember the pecking order theory in your level 1, I guess. So lastly, the contractual and legal restriction is also another consideration when the factors that affect dividend payment in practice. So what you find is that there are some jurisdictions, for example, that mandate dividend payment, that you must pay dividend. If there is a law that says you must pay dividend, then that means company will have to comply with regulation. Otherwise, you run foul of the regulation and you can be penalized. And there are also the other contractual restrictions. For example, if a company has issued bond in the market, there are what we call covenants that also guide the operation of the bond. So sometimes they might say company need to have a certain level of performance before you can pay dividend to your shareholders. So those are some of the contractual regulations. And also, for example, requirement of preference shareholders. Preference shareholders usually have a claim, especially cumulative preference shareholder. You have to pay them first before you can pay the ordinary shareholders. So those are the factors that affect dividend payment. So let's quickly look at the taxation method. There are 3 taxation methods there. I need to just quickly, because these are areas that you also need to pay attention to. There's what we call double taxation. The way dividends are paid in most jurisdictions, you realize that it's subjected to double taxation, because the company, at the company level, corporate level, the company profit will be taxed. And after the company profit before tax, the one that is the profit after tax, just if you are going to be paying it out to your shareholders, shareholder will also be subjected to tax, dividend tax, or in Nigeria, what we call withholding tax. So meanwhile, the company belongs to the shareholder, right? So that is, in essence, more like a double taxation. So when you realize that, if you now want to look at the tax rate, effective tax rate for the individual investor, for double taxation, the effective tax rate will actually be the corporate tax rate. This CTR is corporate tax rate plus 1 minus the corporate tax rate multiplied by the marginal tax rate of the individual investor. So a variant of that, what we call the split rate system. Split rate and double taxation they are similar. The only difference is that they give concession to earnings that are distributed that are paid out to shareholders as dividend. So the corporate tax rate that is applied is actually lower. That is this corporate tax rate, you see the subscript D here, is actually lower than the corporate tax rate that you apply. So the same formula applied. The only difference is that to obviate the impact of double taxation on the individual investor, so the corporate tax rate that's applied is actually lower than what you have under the double taxation method. So the other one that is what we call the dividend imputation method. This one actually is meant to ensure that investors are taxed once. They are not subjected to double taxation. And that is why the effective tax rate is actually the investor marginal tax rate. And what happens is that if the investor marginal tax rate, for example, is 30%, and the company's corporate tax is 35%, for example, if the company has already paid the tax at the corporate level at 35%, and the investor's tax rate, if marginal tax rate is 30%, what it means that the government is owing the investor 5%. So, and the investor will have what we call a franking credit. So that is what that is actually saying. On the other hand, If the investor tax, marginal tax rate is higher than the corporate tax rate, that means the investor will have to pay the balance, the difference. For example, if the investor tax rate 35% and the corporate tax rate 30, so that the investor will have to pay additional 5% tax to make up. So at the end of the effectively, the investor tax, marginal tax rate is the effective tax rate. So that is one thing you need to know there. So let's look at dividend payout policies. There are two here in the past curriculum, maybe for some of you that are a bit, so there is the third one correct, that dividend payout, which has been actually removed from the curriculum. So you don't need to bother about that. So, and this is very straightforward. Stable dividend payout policy. The essence of why this is very most popular, and it's popular because you don't want your dividend to be very volatile, dividend payment year on year. So that investor can actually see stability in terms of dividend payment. And from the perspective of the company, you don't want dividend to be affected by short-term volatility in earnings. So you are not going to be increasing dividend in the same proportion as earnings are growing. So you want to smooth out your dividend payment year on year. And the way to do that is this formula, the Littner formula, which is why the way you increase your dividend so that it doesn't increase in the same proportion as your earnings is to actually scale it by this formula. So your increase in dividend payment is actually what your expected earnings for the next year multiplied by the target payout ratio. Every company has a target payout ratio. Then you divide your previous dividend from it and you scale it by what we call an adjustment factor. And the adjustment factor is 1/n, which is the company estimate how long do they want to their dividend pay policy to adjust to the target payout ratio. So if that number of years is 5 years, so this adjustment factor become 1/5. If it's 4, it's 1/4. And in the exam, if the question should come from that, you'll actually be giving your adjustment factor, the number of years that dividend is supposed to get to the target payout ratio. On the other hand, there is the constant dividend payout policy. This one very straightforward. Constant means that the companies just adopt a policy that says this is a percentage of income you will be paid as dividend of your earnings. You can say your dividend policy is 10%. And if it's 10%, that is 10% every year. So let's be mindful that the fact that we say constant doesn't mean that this is stable. It's in fact very volatile, because if you made 100 million naira or dollars in the year and your dividend policy says 10%, so it means you are paying 10 million naira as dividend that year. And the following year, if you make only 50 million, that means your dividend payment payout will only be 5 million. So it's very volatile. And it's the policy that is usually adopted by companies that operate in cyclical businesses. So let's move on. So share repurchase, which is just an alternative to cash dividend. And what is share repurchase? When companies buy their own shares, right? That is what share repurchase is all about. But you have to know that even though it's an alternative to cash dividend, because it's also involved the use of company cash to execute a share repurchase, but you should know that they do not distribute cash in the same proportion as compared to cash dividend. Why is that so? Because if the company is doing a share repurchase, if all the investors should participate in the share repurchase in the way they should participate equally, then it will be an alternative to cash dividend. But sometimes it's not obligatory that all the shareholders must take up the share repurchase, more engage in the share repurchase exercise. And if they do not engage, that means it might not give you the same result of what you have under a cash dividend. So there are these different methods of executing the share repurchase. And what we need to note here is that for the open market, you are saying you are buying the shares on the floor of the exchange. And one thing to note is that there is no obligation to complete that repurchase program. And there is flexibility in that one, because you can say you announce that you're going to do an open market. You will do it when it is favorable to you, right? When you think that the price is right for you to do it. So you don't have to do it within a particular period of time. You have to time it properly so that it benefits the company. Unlike the open market, the fixed price method and the Dutch auction, both of them, there is an obligation. You need to know that. The only difference is that, so that this is an error. For the Dutch auction, the obligation, the prices is done at a range. It's not at fixed price. I will correct this. While for fixed price, it's done at a particular price. If you say you're going to execute it at 30 naira, for fixed price must be done at that 30 naira. And usually done maybe at a discount to the market price. So it has to entice, incentivize investor to participate in the share repurchase program. But for Dutch auction, it's actually an auction. You are going to do it, speculate a range of prices where it's going to be done. So that's the difference between the fixed price and Dutch auction. For the lastly, the direct negotiation is saying when you want to negotiate to directly with a major shareholder to buy back your shares, there are examples you can find in the market of some of these. And usually, sometimes it might be done at a premium, but also mind that this can also be done at a discount. And in the situation where it will be done at a discount would be if a large shareholder want to sell their shares. So it might be difficult to execute that shares on the floor of the exchange, right? So you might need to want to negotiate and say, I'm willing to take a discount, a haircut, to be able to make sure that this thing is done as quickly as possible. So then the thing you also need to note on this share repurchase method is the fact that there are some consideration for you to know which type of this method will be suitable for the company. There is the cost, if you are looking at cost, if you are looking at timing and flexibility. So those are the three considerations that will make you decide which of these different methods will be more suitable for the corporation. So let's look at when we started, we look at the financial statement effect of paying dividend as opposed to stock dividend. So we also want to look at the financial statement effect of share purchases on both the balance sheet and the income statement. For balance sheet, we understand that because it involves payment, a use of surplus cash. So you realize that leverage will increase because when you pay out cash, it actually increases the leverage of the company. And leverage will also be elevated if it's funded with borrowing, with debt, because the leverage will even increase more. So, but on the book value per share, there is also an impact. So what the impact is dependent on what the relationship between the share that is being repurchased, the price at which the share is repurchased, and the book value. So what you need to note is this: when the market price per share is greater than the book value per share, that is the price at which the share is going to be repurchased, is greater than the book value of the company. Book value is the net worth of the company, right? Then book value per share will decrease after the repurchase, and vice versa. What are we saying here? If market price per share that with that repurchase is being done is lower than book value, then book value per share will increase. And you can validate it by using the formula. But in the exams, a lot of time when they ask questions around this, you might not even need to calculate, because sometimes if you understand some of this concept, you just to figure it out and just go on, except when they ask you to calculate what the book value per share will be after the purchase. That is when you need to calculate. And what is the formula for book value per share? It's your shareholder equity divided by shares after the buyback, the outstanding shares after the buyback. And how do you calculate that? Book value per share divided by shares before the buyback minus the number of shares that is being bought back. So what you need, if you use that formula to calculate, you realize that this relationship will hold true. But importantly, you don't need to calculate if it's not required. If they are asking you what will be the impact on book value per share, the data they gave you, all you need to figure out is to look at the relationship between the price at which the share is going to be purchased compared to the book value per share of the company. If the repurchase share price is going to be greater than the book value per share, then book value will decrease, and the opposite is also true. So in terms of the income statement effect, fair share, because when you do a share repurchase, the number of shares will also reduce, right? So, but the impact on earnings per share will depend on some factors. One, if you are using, normally before now you realize that we say, okay, if you do share repurchase, EPS should go up, but it's not always true. The first one, are you using internal funding for doing the purchase? If that is the case, EPS will only increase if you are using surplus cash. And by surplus cash, you are saying that if you do not have any profitable NPB, positive NPB project that you can deploy that cash to, then EPS will go up. But because if you are doing a purchase and there are no possibility, you can add value to the company, EPS will rise. Secondly, are you using borrowing for the purchase? If you are using borrowing, then whether EPS will go up or down will depend on what the relationship between the earnings yield of the company and the after-tax cost of borrowing or financing. So what we're saying here is that EPS will rise or increase if the company's earnings yield is going to be greater than the after-tax cost of borrowing, because you're adding value, and that is the intuition. You are not destroying value. But if the earnings is going to be lower than the after-tax cost of financing, then EPS will drop. But if earnings is going to be equal to after-tax cost of financing, then EPS will remain constant. So those are the things you need to be mindful of. And just like I said under the book value per share effect, for EPS too, what is the formula for calculating EPS? Your net income divided by what? Your number of shares outstanding. But in this case, it will be your net income minus the cost after tax cost of financing minus after you deduct tax 1 minus T divided by the shares after buyback. So if you are using surplus card, your after tax cost of financing will be 0. So it's just your net income divided by your number of shares outstanding after the purchase. So just like I also emphasize, you don't need to calculate here. If the question is just asking you what will be the impact on EPS if you've done the purchase, they'll give you the data. All you need to look at in the data you are given is to calculate earnings yield. And you know earnings yield now is just the inverse of PE ratio, right? PE ratio is price over earnings, but earnings is the earnings over price. So if you are giving PE ratio in the data, all you need to do, you know that the earnings will just be the inverse of your PE ratio. And the after-tax cost of financing you'll be given. If you are not given, you can easily figure out in the data set that is given to you. So finally, the last point on dividends, dividend coverage ratio. I won't bore you with this. Dividend coverage ratio is just the inverse of what? Your dividend payout. So, which is similar to when you are calculating your coverage ratio for debt. So,
Sorry,
a
I
higher
have a
dividend coverage
question.
ratio means that there is the ability of the company to pay dividend might be sustainable. So, our alternative to doing that is to also use instead of using dividend as your what is it called? Earnings are your numerator here. Because this is earnings over dividend. You can also use what we call your free cash flow to equity as your numerator. That is what this other one is saying. So I think that will just end this first level discussion because I have 1 hour, so I need to actually manage my time properly. So the second module, maybe if you have questions, you can know your questions down. Once I'm done, I'll give you an opportunity to ask your questions. So the second module is on ESG, constitutional investment analysis. I won't spend much time here because this is just an extension of your corporate governance module level 1. The only addition is the ESG, and I'm very sure ESG is now the buzzword that almost all of us are conversant with. So the areas I feel you have not been covered in your corporate governance, that's what I'll focus on. The first part of the reading look at disagree between dispersed and concentrated ownership. Dispersed ownership means that where you have a large number of shareholders with none of them having the ability to actually control the corporation. On the other hand, concentrated ownership means when an individual shareholder, a group or a family have controlling stake in the company. And most time, what will make you have control is when you have more than 50% ownership in the company. But more importantly, it's also important to know that ownership alone doesn't give you control. So that is one thing we need to note. So here. So and the second part, look at the conflict within the different ownership structures. So I'm very sure we've already had what we call the principal agent problem. When you have a situation where you have dispersed ownership and dispersed voting power. So just like I mentioned earlier in the previous slide, the fact that you have dispersed ownership will actually mean you have dispersed ownership because nobody has the controlling stake in the company. What you have here is that most shareholders will not have the power to exercise control over managers. And in that case, this situation results in what we call having a weak shareholders and strong managers. And this is the classic case of a principal agent problem, which is something we discuss under agency theory at length. So the second situation is you can have a concentrated ownership and concentrated voting power, which is just the opposite of this one. In this situation, you end up having strong shareholders versus weak managers. In this case, principal agent problem will be very significantly mitigated, but this leads to another problem, which we will call principal problem. So, and that principal problem is that majority will always carry the day. So the interest of the minority shareholder might not be protected. And that is what we call the principal problem. So when you also have dispersed ownership and concentrated voting power, this also, in this case, you have strong shareholders with managers, and principal agent problem is also mitigated, but it also leads to principal problem. So you have concentrated ownership and dispersed voting power. So this usually will happen when there are restrictions on the voting rights of large shareholders. Maybe there is a voting cap, for example. So that is when this situation will arise. So for this is just evaluating corporate governance. I will not bore you with this. It's something you are familiar with. You can go through at least the material, will make it available for you to. So now we look at if you want to identify ESG factors. There are two major considerations: materiality and the investment horizon, which is the time, because you need to analyze the materiality of the data. So materiality will relate to how the issues affect the operations of the company, financial performance, and the valuation of the security. Because when you look at ESG, the E represents the environment, S social, and the G governance, which is corporate governance that has been covered extensively, right? Even though all these three factors are important in investment analysis now, because you are incorporating environment and social. Before now, it's only governance that people look at when you are going to be evaluating a company, whether you want to invest in the company. But now, environment and social have also assumed increasing importance. You realize, depending on the industry you are going to be analyzing, some of these factors, the impact of some of these factors will vary. For example, if you are analyzing an oil and gas company, you realize that environmental factor might be very, very dominant and significant. And social might not be as significant. Social might also be significant, but environment will very significant. If you are analyzing maybe a pharmaceutical company, for example, social factor will be much more dominant than maybe environmental factor, and which is the issue we are talking about here. Then the other part is that investment horizon is also important, determining the ESG factor to consider when you're analyzing investment, whether to invest. And this is particularly very important when you're going to be doing bond investment. Because if the investment you are doing for bond is long-term or short-term, some ESG factors like that you have might not impact the company in the short run, but might impact that company in the long run. And that is why investment horizon is also very important when you are trying to determine what the factors that are very relevant for your investment analysis. So, and the fact is that ESG's considerations are a bit more difficult, especially when it comes to environmental and social issues. Because for the corporate governance, that one has become very codified in our laws. You have a lot of laws that talk about corporate governance and what to look out for. But for ESG, for E and the S, which is environmental, to determine the relevant factor can be a bit more difficult because there is no mandatory law for it now that says this is what you should look at. And there are different sources of data that you have to look at to do that. So for you to identify ESG factors that are relevant, this method you can use, proprietary method, just using the company's internally developed models or tools to identify those met factors. And there are other external providers, like what we call the ESG data providers. For example, Standard Analytics, Moody Analytics, Infinitive ESG, they are all examples. If you go online, you see them. They can give you a guide of all the different factors you need to look at, depending on the sectors you are analyzing. And there are some non-for-profit organizations too that give you an idea of what to look at for. For example, the International Integrated Reporting Council, the Global Reporting Initiative, GRI, they talk about sustainability reporting standard. And there is the SAP, which developed what we call the SAP materiality map. And there is also the 2-degree investing initiative that look at the Paris Agreement, essentially. So now, when you're analyzing, if you want to integrate ESG into your investment analysis, either for equity or fixed income, the only point I would want us to note here is that if it's equity analysis you are doing, so ESG integrator has to identify both what opportunities and what downside risk. For equities, the upside potential is infinite, right? And there is also downside risk. So when you are looking at it from an equity analyst perspective, you have to look at what are the opportunities, what are the risks. But if you are looking at it from a fixed income perspective, fixed income, when you invest in a bond and you want to hold it to maturity, there is no upside, right? Because the bond was always redeemed at par, isn't it? Whether even if you bought the bond at a premium or at a discount, at the end of the day, it has to be redeemed at par. So what you usually focus on when you are looking at fixed income analysis to mitigate, how do you mitigate downside risk? Those are the things I need to focus on here. So finally, let's look at green bond. I'm very sure most of us have heard about green bond, but what you need to understand for green bond is the fact that it's just more like plain vanilla bond from when you're analyzing from ESG integration. So what the difference between a green bond and a non-plain vanilla bond is the fact that it's just in the use of proceed. So for green bonds, the use of proceed, they are designated to fund specific projects that have what climate or environmental benefit. So in terms of analyzing a green bond, the same procedure, the same principle apply. It's just in the use of proceed. So you typically find that the green bond will have the same credit risk as conventional bonds of the same issuer, all things being equal. The only thing is that sometimes in practice, you realize that green bond might command a relatively high premium in the market, because now you realize a lot of investors are demanding for green bond. They are demanding for companies that are environmentally responsible and socially responsible. And because of that demand for green bond, they usually tend to command a higher premium in the market. And the typical risk that you associate with green bonds will be what we call greenwashing. Greenwashing is just saying that you are saying you've issued the bond and you are now going to be diverting that fund to do something that is contrary to what you are supposed to lend it for. Instead of using for that particular purpose that will benefit the environment, you are now diverting that fund to do something else. And that's what we call case of greenwashing. And can also be subjected to liquidity risk for the simple reason that when most of these bonds, people don't tend to hold them to maturity, the investors. So this might not be as liquid as the conventional bonds. So those are the two risks. And that will end my discussion around the second module, which is ESG consideration. Okay, maybe this last point, just what are the things you look at when you're analyzing it? You need to look at how with these ESG factors, environmental factors that you identify, how will they impact the income and cash flow statement, so that you can now model your income statement to adjust for those issues around ESG. And you also might need to adjust for your balance sheet if there is a case of an impaired asset. Impaired asset means the asset that might no longer be useful because of the fact that you need to change your asset to align with comply with ESG regulation, for example. And another way to also look at it, you might also need to adjust your cost of capital, because if the risk around ESG are more elevated, that means your every weighted cost of capital might have to be increased, which will impact your valuation. And the same thing goes for bond. So it might impact the credit spread of the bond as well. So that is that around the ESG. So I think we're right on time. So module 3 look at cost of capital. Cost of capital is a familiar topic that you've done in level 1. So we'll just highlight some of the maybe additional changes. The first thing we look at here is the cost of factors that impact cost of capital. And what they've done here is to look at top-down, categorize them into top-down, which are external factors, and what we call the bottom-up, which are company-specific. Remember the top-down approach in your industry analysis, and essentially what this is saying. So for top-down factor, you have the capital availability, market conditions, liquidity and regulatory consideration, and tax jurisdiction. While on the other hand, these are company-specific issues. So we'll just go through each of these factors in turn. For top-down, capital availability, what this is just saying that you realize that because developed markets economy usually have very well-established liquid capital market. So because they have very established liquid market and more stable currency, better property protection, the risk associated with company investing in those jurisdictions are usually lower than companies that are in developing market. Because of that, you realize that the risk premium that the credit spread demanded by investors are usually higher in developing economies compared to what developed society. That's what capital availability is speaking to. For market conditions, that is market conditions. How cost of capital is also influenced by issues around market prices. Pricing the market, like interest rate, inflation rate, FS rate. We don't need to bore you them. We know what's happening even in our country today, whereby in the last 1 or 2 years, because of market condition, the cost of capital has actually risen significantly. And that is what number 2 is saying. So for legal and regulatory consideration, country risk, you also need to look at the country risk. Higher country risk means that the spread for that will be demanded by investors will be higher. Then lastly, tax jurisdiction. We already talked about tax agreement earlier. So interest expense usually tax deductible expense. So which also reduce cost of capital. So if the marginal income tax rate is very higher, you realize that the greater the tax benefits as well using debt in capital structure, we might also impact the cost of capital as well. So for bottom up, the first one is revenue, earnings and cash flow volatility of the company. And this is what we already summarized there. So if a company has, these are very, very intuitive, so you don't need to cram them. Higher stability of revenue and earnings mean that the effect on cost of capital will be lower. That means lower cost of capital, right? So if you have a company that have a higher revenue concentration, impact will be the higher cost of capital. So if the earnings are more predictable, that means they are more stable, which is the opposite of volatility, lower cost of capital, right? Higher operating leverage means what? Higher cost of capital. Anytime you hear leverage, if the leverage is higher, because there is operating leverage and financial leverage, so cost of capital will be higher. Then if the ESG risks are elevated, the cost of capital will also be higher. For asset nature and liquidity, if you have a higher proportion of fungible and tangible asset means asset can easily be exchangeable. And one common example of fungible asset will be cash. So you realize that the impact on cost of capital will also be lower. So if you have a higher proportion of liquid asset to lower. So on the other hand, if you have a higher proportion in intangible asset, cost of capital will be higher because you might not have asset that you can use as collateral. And you know, if you are collateralizing a loan, it will actually impact the cost of capital positively, right? So number 3 is talking about financial strength of the company. And in that case too, all these are very straightforward. Higher profitability means lower cost of capital. The same thing goes for cash flow generation. And if you have higher interest coverage, which give you higher indication of liquidity, also lower cost of capital. Leverage ratios, which we already discussed, higher leverage, higher cost of capital, lower leverage, lower cost of capital. Then security features. You realize that some companies, when you're issuing some debt, they have some embedded features such as call option and puttable option. This one is something you're already familiar with in level 1. So if there has a call option, so you know, because that won't benefit the company at the expense of the investor. So the investor will demand for a higher premium, which is why the cost of capital will be higher. On the other hand, puttability is the opposite, lower cost of capital because it benefits the investor. So there will be a premium for issuing them. The same thing goes for convertibility, lower cost of capital. So cumulative preferred, if a cumulative preference share will command lower cost of capital because the risk is also lower, right? And common equity, the risk is higher to higher cost of capital, right? So now, the different methods for estimating cost of capital. So cost of debt, first of all, let's look at the method for estimating cost of debt. The first one here is to look at what type of debt you are issuing, the nature of how liquid or marketable is the debt that is being issued. Does it have a credit rating, for example, and the currency which is issued? And this one just gives us the summary. If it's a traded debt that is very liquid, that is traded on an exchange, how do you estimate cost? The best starting point to estimating cost of debt is to look at what? The default is to look at the longest the existing that have the longest maturity. So the yield to maturity on that debt will be an estimate of the company cost of issuing new debt. But if the company has shorter term bonds that are more liquid and trade more frequently, then the yield to maturity on the short term very liquid debt might also be used as a reliable estimate of estimating the company cost of debt. So what if the debts are not traded? If they are not traded, you can use what? Similar companies, the maturity, use the yield to maturity of bonds issued by similar companies within the same industry. And you apply what we call metric pricing to estimate the yield to maturity. Metric pricing is something you dealt with in level 1, I think. So I don't need to bore you with that. So, and if there is no credit rating, what do you do? So you can actually do what we call systematic credit rating for the company. So use the company fundamentals, characterize some of the leverage issue because, and this is something you must have done in your fixed income level 1, how you can use financial issue to estimate what the likely credit rating of a bond will be. Once you've gotten that credit rating, then you default to using the number 1, which is matrix pricing to actually estimate the cost of debt. So if the company has also recently issued a new bank debt, and you do not believe that market conditions have changed materially since that issuance, the cost of issuing that bank debt can be used as a reasonable estimate for estimating the cost of debt for the company. Then for leases too, the implicit rate, which is calculated by looking at the present value of the cash flows of the leases, you can use that one to also estimate the cost of debt of a company as well. So equity risk premium. So how do you estimate equity risk premium? There are 2 major methods. You can actually use what we call the historical approach, which is what we call the ESPO, looking backward trend analysis, historical basis, or you can look at the forward-looking approach. For historical approach, So there are some key decisions you need to look at. So what index are you going to use? Equity index selection. Are you going to be using a broad-based market-weighted index? The one preferred is usually to use a market value-weighted index as opposed to maybe price-weighted or equal-weighted. Then time period are you looking at for the equity? Are you looking at short-term or longer-term? In general, analysts tend to favor longer-term period because for selection of the mean type as well, you do want to use arithmetic mean or geometric mean. Geometry is usually preferred because it's less sensitive to outliers as well. And it's also consistent with the principle of compounding, when you're compounding your interest. So geometry. Then finally, selection of the risk-free rate as a proxy. Are you also using your short-term government rate or the long-term yield on the long-term government bond? Industry practice also favor the use of long-term bond as the yield to maturity to measure the duration of the infinite life equity security. So for the forward-looking approach, there are three major methods. You can use the survey approach, the DDM model estimate, and the macroeconomic model. For survey approach, very straightforward. All you are just saying, you are just conducting a poll among the experts, like CFA shareholder in Nigeria. You can ask them to do a poll that what do you estimate to be the equity premium for this country for this year. It's just estimate based on poll conducted. For the DDM model, that is straightforward. You are just working back to derive. For DDM model, you can use the Gordon Growth approach, for example, which is saying your Gordon Growth is saying D1 over what? R minus G. So, and your R, which is the denominator, is actually the cost of equity, right? So you can now work by that, changing the subject of formula to derive your cost of equity. So if you are now using the ERP, you will now be deducting your risk-free rate from what you get to get your cost equity risk premium. So, and if for fast-growing economies too, or companies, you can also use the multi-stage approach to valuation and try to figure out what the discount rate is in the denominator. Then for macroeconomic modeling, this Krona, I don't know whether you guys done it in the economies. There is this model where you can decompose the different drivers of return on equity. And one of the drivers he has arrived at is that equity risk premium, there are different drivers. One of the drivers is what? The dividend yield is a positive driver of risk premium. Then the changes in price to earning ratios of the broad market index. Inflation, I mean inflation, that this is the growth rate, minus changes in the shares outstanding. Then when you deduct your risk-free rate, you get your equity risk premium. So all you need to know is that the drivers of equity risk premium, according to the Krona model, is dividend yield, positive, changes in price to earnings, positive, changes to inflation positive, growth positive. The only negative here is what? Changes in shares outstanding. So that is the way to estimate equity risk premium using the macroeconomic model, using the Krona model. So, and the same principle, because once you estimate cost of equity risk premium, the same principle also apply for estimating what risk-free cost of equity, that is the return on equity. Dividend discount model, we already discussed. You can use the Gordon Growth approach or the multi-stage approach. Then you can also use the bond yield plus yield premium, which is just saying that the risk premium, what is the cost of equity? Which should actually be the starting point should be the what? Cost of debt, because equity is riskier than debt. So cost of debt plus a risk premium to account for the increased risk in what? Equity, which is cost of debt plus a risk premium. Then the lastly is the risk-based model. Under the risk model, you can use the CAPM and the Farmer French approach, which we are familiar already with at level 1. So, but for risk model, one thing we are looking at risk from the perspective of there are two elements to cost of equity. One, the compensation for what? Time value of money, and the compensation for risk. So when you are looking at this, you are looking at CAPM. So you are saying the risk return, you can return equity is what? It's a function of the risk rate plus what? Equity risk premium, which is what? Modeled by the beta. The beta is the sensitivity of the company to the entire market, right? So for Farmer French, just an extension of the capital market CAPM model. And what that is saying is that the equity risk premium is not the only factor that would explain the return on equity. So there are other factors that you can also model. So, and the popular one is the three-factor model, which also now, beyond looking at the equity risk premium, you also look accounting for the size of the company, and the other one, you're also accounting for the value and size, right? So, which is gives us, and this is the formula that you're aware of already. So there is also, you can also extend the Farmer French model to capture additional factor, which you now call the five-factor model. You have the additional factor, which is called by the profitability premium, then, and the one that is talking about the investment premium. So we don't need to bore you with that. So then, if you're estimating cost of equity for private companies, so what you need to look at is you have to look at size premium, industry premium, and the company specific premium. So there are some two methods that you can use. Two choices. You can use what called the expanded CAPEX. Expanded CAPEX is just saying that, which is now saying that you are looking at because this is a private company, you cannot estimate the beta of the company directly. So you might have to use the beta of a peer company. So you just add additional factors. This one will account for size, industry premium, plus the specific country risk premium. The difference, what you need to note here, there is difference between the expanded CAPEX and the build-up approach is the fact that for build-up approach, there is no beta. Build-up approach just look at the risk-free rate plus all the risk factors without modeling for beta of the company. That is one thing I need you to note here. The standard CAPEX versus the build-up approach, right? So finally, you look at the risk, country spread and risk international constitution. You are going to be estimating cost of equity for developing countries. For example, you have to model for the country risk and the country spread. And the country's risk premium is actually, according to Damodaran, that's what is the sovereign risk spread. And that sovereign risk spread is what? The difference between, for example, if you are going to calculate the country spread for Nigeria, you are looking at maybe if Nigeria has issued a Eurobond at say 10%, and America has issued a Eurobond at 2 or 3%. The differential between the two rates is actually the country's premium spread of Nigeria. So you are going to scale it by the volatility of the local equities market return and the volatility of the local bonds return to get the country risk premium. For emerging market, this model is also what? Equity risk premium is now what? Once you determine the country risk premium, the equity risk premium will now be equity risk premium for the dollar market. For example, you are seeing America as a proxy. Plus what? Lambda. Lambda is more like similar to beta, which is now the level of exposure of that country to the local economy. Then multiplied by the country risk premium, which we already figure out here. So that will be the last part on cost of equity, cost of capital. So let's quickly look at corporate restructuring. So before we wrap up, for corporate restructuring, it's actually a modification of the merger and acquisition rating. And what are the things we need to note here? Remember this corporate, the life cycle of an industry, where you have the stages in the life cycle and how it happens. And this thing is also the reason why at a point in time, the company's good can be stalled when the company reaches maturity. So if you do not do something about the company might die a natural death, because after a time, when the revenue begin to decline, it's a matter of when will the company eventually collapse, right? So now, when you are now looking at the corporate life cycle, there are the types of corporate structural changes you can apply. There are three things you can do. You can do what we call investment, divestment, and restructuring. For investment, what you need to notice that is increasing the size of the company. And that is why what you do under investment usually may be acquisition of another company to increase the size of the business. When you are doing the investment, just the opposite of investment, you are decreasing the size. And in that case, you can do what? Sell a section of the business that you feel is not doing well, or you can do what? Do a spin-off, which we'll see shortly. For restructuring, you are neither increasing or reducing size of the business. What you are doing is to improve the functions of that business by engaging in some activities. So you might want to increase the growth of the business or improve profitability or either reduce risk. So what are the motivations for corporate restructuring? There are issuer specific motivations and top-down drivers. Issuer motivations, most time when you're doing mergers and acquisitions, you talk about synergies. You can also want to increase growth or improve the capabilities of the business, or opportunity to acquire maybe undervalued assets for investment. For divestment, focus on operation, valuation, liquidity needs. It can also be a regulatory requirement. For example, in Nigeria, when the CBN asked banks to actually divest from non-core activity, that led to a lot of banks selling some of those non-bank businesses at the end of the day, which is a regulatory requirement. So restructuring can also be either to improve return on capital, maybe because of financial challenges, including maybe bankruptcy or liquidation. Top down, if the security prices are rising, it can also motivate sometimes maybe either a divestment or investment, or industry choice can be led by industry issues, right? So for types of corporate restructuring, we are now breaking it down by saying if you are increasing investment, there are different types. Equity investment, you can do what we call JP or acquisition. For the investment, you can do sale or spin-off. Restructuring, you can do three: cost restructuring, balance sheet restructuring, or organization. Leverage buyout cut across all the three, because what you are doing here is actually, you are doing a leverage buyout can actually have element of investment, divestment, and restructuring. And one thing you need to note is that as you go down here from equity investment to joint venture to acquisition, or from sale to spin-off, or from cut to organization, it's actually the impact on the business is actually increasing, which is what this arrow here indicates. So just briefly look at equity investment. Equity investment, when you are buying a material stake, but not a controlling stake in a company, usually less than 50%. For joint venture, two or more companies are joined, you are forming a new separate company to achieve a business objective. Acquisition is when you acquire another company entirely. So that is what this is saying. For divestment, there are two things you can do. Either you do a sale or a spin-off. Sale is another name for sale is what we call divestiture. You are divesting. And one thing you need to know between the difference between the two is that for divestiture, it will generate cash for the business. But spin-off doesn't. What spin-off it does, you are just separating two companies, maybe a parent, you now separate it into two entities, whereby the shareholders will now own shares in the two separate entities, rather than owning shares in one entity. But it does not result in cash generation for the business. That is very important for you to note. Difference between a divestiture and a spin-off. So for restructuring, cost restructuring, you can do what we call outsourcing and or offshoring. Difference between outsourcing and offshoring is that outsourcing, you're outsourcing some areas of the business that you feel is not core, like back office operation, IT, legal, HR, to other companies. Offshoring, you are relocating operation to another country. That is the difference between offshoring and outsourcing. For balance sheet restructuring, there are two types. You can do what we call a sale leaseback, whereby you sell an asset of the company and now lease it back so that you can free cash flow for the business. Dividend recapitalization, when you structure the mix of debt and equity from to debt finance dividend, or maybe do a share purchase, that is what we call dividend recapitalization. Reorganization is actually reorganizing the company entirely. And this is very, very popular in the US, for example, where you have what we call the Chapter 7 and Chapter 11 under bankruptcy proceeding. Under the Chapter 11, companies are actually allowed to go and reorganize the company. Instead of liquidating the company outrightly, you can go and reorganize the company to ensure that subsequently the company begin to do well, and you can now sell the company later if you need to do that. Every buyout is something you are familiar with in your alternative investment, so I won't bore you with that. So when you're evaluating corporate structural hedging, this is the way. Initial evaluation, you have to ask the question, what is the purpose? Why are you doing it? Is the corporate structuring going to be material? And when are you going to do it? Preliminary evaluation is just talking about the valuation. And when you are looking at valuation, you're looking at relative valuation principle. So the same thing, you look at multiples. Either you use the multiple ratio like enterprise to EBITDA or price to earnings multiple to evaluating the company. Modeling and valuation is just talking about the DCF model of valuation. And that is what the modeling and valuation is. So for initial valuation, one of the two things you're looking at is size and fit. So you have to look at how material is the materiality. Will be looking at context, size and fit of the business that you're going to acquire, for example. And one of these rule of thumb to determine size is what? If the total transaction value, you need to know this, exceed 10% of the acquired enterprise value prior to the transaction. For example, the transaction you want to conduct, if the total value of that transaction is going to be more than 10% of the entire value of the company before the transaction, then that transaction will be considered to be large or material. For preliminary valuation, so what you see here is that this method is something you are familiar with. The only thing here is that compare every company analysis, just saying you're using your relative valuation, which you've done extensively in your valuation in your equity investment. So you are using valuation multiple to value the company. The only thing that you might not have done is what we call the comparable transaction analysis. This one, instead of using the company, your numerator here, you're using price of the company on the exchange. But here, the numerator here, you're using what? The acquisition price. You are not using the price of the company on the exchange. You are using acquisition price of related acquisition that have been done in the past. So because you are using the acquisition price under the company transaction analysis, your what we call the takeover premium is already incorporated in the acquisition price. Because when you acquire a company, there must be a premium you are paying for it for the target to sell it to you. If you are using comparable company analysis, you need to estimate the premium, takeover premium, and add it to the whatever value you get to arrive at the acquisition price for the business. But under the company transaction analysis, acquisition price is already embedded in your computation because you are using acquisition price as your numerator. This premium paid analysis is just not really a method. It's just saying that if you are using comparable company analysis, you need to now estimate what your premium and add that to your comparable company analysis to arrive at the acquisition price for the business. I hope that is clear. So these are some of the advantages. You can look at the advantages later, so let me not bore you with that. Finally, modeling, which is now saying if you want to do the DCF approach, you need to now look at combine the businesses of the acquire and target, financing, how are you financing the business? Are you issuing new debt? So you need to add, and if you are issuing new debt, the additional interest expense have to be modeled in your DCF model. Then if you are issuing new shares, if you are there any synergies in terms of revenue or cost, all those have to be modeled in your DCF model, and all the any accounting adjustment in terms of goodwill and taxes that you need to do. So that is what you have to also do as well. This one just formally explain it. What do you need to do when you are doing your pro forma income statement for you to be able to estimate your free cash flow at the end of the day? Combine the entities. The previous slide just explained what I already explained in the previous slide. So that will be the end of my talk. I think I've managed the time very well. I don't know whether we'll have time, the coordinator, whether we can just go through some questions.
The next facilitator is actually in the room, Damilare Ojo. Dare, would you give us like 2 minutes for him to quickly answer questions? Would that work? Okay, Shagun, please go ahead.
Oh, thank you so much, Bukola. So if there are no questions, can you just give me maybe answer to this? Anybody, maybe you want to type your answer or you want to just unmute and speak. What is the answer to the type your question or response? Which of the following factors is it likely to be associated with the company having a low dividend payout ratio? So I see you. Some people are A, B. Okay. The answer is C, actually. Low dividend payout. If you have high flotation costs, I talk about those factors affecting dividend. High flotation costs mean that what? The company will tend to pay what? It's least likely. I hope you need to know that. Least likely. So maybe that is why you guys are getting it wrong. So that is C is the answer, right? So for this one, can we quickly figure out this? This one is talking about the impact of what's called share repurchase on what EPS. And I told you that is what you need to just figure out here is the relationship between earnings yield and what? The after-tax cost of debt. In this case, the after-tax cost of debt is what? Is already giving 3%. What is your earnings? Earnings yield will be inverse of this, 1/25. So because earnings is 4%, which is greater than after-tax cost of debt at 3%, that means EPS will what? Will increase. So here is the correct answer, right? So let me look at another question we can look at. So for this ESG, number 4, So B is correct because the level of disclosure varies considerably among companies. CSG disclosure are voluntary. I think I mentioned it earlier. So I think I will pause here. I still have some other question. I will make the slide available for you through the CFA Society Nigeria, so you can look at them later. So if there are no questions, I think I will respectfully take my bow. Thank you so much for having me, and I wish you
Thank you
the
so
very
much,
best of
Sergeant.
luck.
Thank you very much. Thank you. This is to inform everyone that the slides will be available to all. By the time we send out our feedback form for our feedback survey, please click on it. You would, after filling the form, you will receive the slides. Please, so don't worry, you will get the slides. Thank you so much. Over to you, Damilari. This will be the last class for today. Then we'll see you all tomorrow by God's grace. Damilari, over to you.
All right. Thank you so much, Bukola. And over to you, then.
Damilari, we can't hear you if you can hear us. You are still muted. Damilare, can you hear us now? We can't hear you. You are still muted. We're sorry for the technical glitch. Okay, you can hear us now? Yes, I
Yeah, I had
can
to
hear you.
laptop. I don't know what's happening on the other laptop. So just give me a second. I had to send a file to my other laptop. So I'm just setting up on the other laptop now.
No problem.
Just a second.
No problem. Thank you.
Yeah. Okay. Good afternoon, everyone, and thank you for your patience. I'm not sure what's going on, but okay, I think I'm all set now. So I'm just going to, we're about 9 minutes behind, so I guess I'll just dive straight into it. Okay, so I'm sharing my screen. I believe you can all see my screen now. So we'll be looking at the equity valuation model, and just try to do one or two things within 1 hour or in less than 1 hour, 30 minutes now for the time that we have left. So there are a couple of lectures, or what do you call it now? A couple of topics that we are expected to look at for this particular equity valuation module, but we are going to just try and move as fast as we can and look at the ones that we can look at within the time that we have to spend together this afternoon. So the first of them is equity valuation applications and processes. Can I just confirm that you can hear me? So I'm not talking to myself.
I hear you.
Okay, great. Thank you for the confirmation. So I believe you can see my screen as well. So equity valuation applications and processes. This first reading of this module is just trying to build a foundation for the entire equity valuation module. So it has a couple of learning outcomes, but of course I'm not going to dwell on them one after the other because of our time. So I'm going to start with some key concepts, and as we go on, I'll try and be switching between and the chat box. So if anybody has any question, we can probably, as much as time would permit us, take some of those. So we'll also have some practice questions along the way, so you can get set for those so we can move as fast as possible. So when we say valuation, this is equity valuation, yeah. So when we say valuation, what do we mean? I mean, the first thing, one of the most important things that we need to know as prospective, I mean, I wouldn't say equity valuation experts now, because different people have different paths for doing CFA or reasons for doing CFA. But when equity analysts talk about equity valuation, one of the things that we want you to know is that market price is different from market value. So when we say value, value is different from price. Something can be valued at, maybe 1,000 naira as an instance, but the price is actually 700. So CFA Institute wants us to know the difference between value and price, and to know when we say in this instance, an equity, a stock is undervalued, fairly valued, or overvalued. So if price is equal to value, then we say the stock is fairly valued. If the market price is higher than the value, so if market price is 1,500 while the value is actually 1,000, then you say it is overvalued, right? But if you flip that around, and if market price is lower than the value, so say value is 1,000 and the market price is 700, so you say that stock is undervalued. So those are very important concepts that they want us to know. So valuation is just the process, of estimating the worth essentially of a stock. I mean, you can value anything. You can value you can value nows, you can value a company, you can value equity, you can value even an individual, right? You talk of most wealthy people, that comes from valuation of different things that they own, right? So you can value anything, you can value any assets as the case may be. But in this instance, we are very much particular about equity valuation. Okay. So when we say intrinsic value of an asset, it says it is given an hypothetically complete understanding of the asset's investment characteristics, right? So what is the value of an asset if we believe that we know everything about that asset? We know everything about, say, the past, the present, and the future of that asset. So, and that is really hypothetical. I mean, nobody knows the future, absolutely in its entirety, right? So nobody can say they know the future accurately. So that's why the word hypothetical is very important. So, but when you say, okay, we have a complete understanding hypothetically of an asset and its characteristics. So when we value an asset based on that hypothetical understanding that we have, then we say intrinsic value. And here, the second bullet point just saying versus market price. So market price is the current price, right? But when you say an estimate of an intrinsic value of an asset, which reflects one's view of the true or real value, that is intrinsic value. So again, just emphasizing the fact that intrinsic value is different from market price. Market price is the price that you will get that asset today in the market, but intrinsic value is the value that you place on that asset based on your hypothetical, understanding of the entirety of the characteristics of that asset. Okay, and I've touched on mispricing. When we say overvalue, undervalued, so that talks to mispricing. So when price departs from value, so price is not equal to value. So we say if value is greater than price, right? So value is greater than price, say the stock is undervalued. If value is less than price, you say the stock is overvalued, right? And then this last two concepts are just, they are just telling us what to bear in mind when conducting valuation. Are we conducting valuation based on a going concern, which means the company will continue to operate into the foreseeable future? Or are we valuing a stock based on its liquidation value, or a company based on its liquidation value, which means we are saying the company is going to be dissolved and all its assets sold? So we have to also just know these two concepts, just as a building block to what we are doing. So when we conduct valuation, when you hear valuation, more often than not, we are talking about the going concern value, which means we are valuing a stock based on the fact that it is going to, the company that the stock is underlying is going to exist into the foreseeable future. Okay. And then the valuation process, there are 5 major processes that the CFA curriculum wants us to be aware of, that most equity analysts, typically follow. It's not a strict thing, but they are just things for us to bear in mind, for us to be aware of when we are conducting valuation or thinking about the valuation process. The first thing is that we have to understand the business. You can't value a company or a stock that you don't understand the underlying business, right? There's no way you can say, okay, this thing is worth this amount without you knowing what is underlying that valuation. Remember, we talked about valuation as something you do based on your hypothetical understanding of the entire characteristics, right? One of the characteristics, or the essential characteristic, is the business of the company that the stock is traded upon, right? And this also comes from understanding the industry in which the company operates or the business operates in. So industry and competitive analysis, where you talk about your Porter's 5 forces, right? Your rivalry in the markets, bargaining power of customers. You have the competitive landscape. You talk about bargaining power of those who supply the company as well. So those things, you have to have a very good understanding of them for you to conduct a reliable valuation. And then financial statement analysis, of course, this is another topic on its own, but here we are just mentioning it for us to say we need to understand the business by also understanding the financials of the company, of the business. So we need to dissect the financials for us to understand the business and to be able to conduct valuation. Because what happens is you can conduct valuation based on you don't want to make a mistake by conducting valuation based on numbers that are not reasonable. You can have some unusual items that you need to adjust for in the financial statement. You can have, some events occur that they are not expected to reoccur in the future. Maybe a company is doing a share repurchase. The question is, do you expect them to continue to do share repurchase into the nearest future? So you need to adjust for, things like that. Or maybe a company has just sold one of its assets, and then that gives them a huge, maybe they have a revaluation gain, and that increases their net income. Some of those items you need to adjust them when you are conducting valuation, because you need to do some form of forecasting to do your valuation. So you don't want to just forecast items that are non-reoccurring. So that's why financial statement analysis is also very important. Then there are some corporate strategies that we also need to bear in mind in terms of understanding the business. So you have 3 corporate strategies that CFA curriculum wants us to know. So you have cost leadership. So there might be a company that you have an industry, where you have oligopoly. I mean, this is one of the readings that you must have come across during level 1. So oligopoly, you have few sellers, but there is one of them that is the cost leader. So you have to factor that in when you are also doing, your valuation, in terms of understanding the business. Is this business that I'm valuing the stock the cost leader, or is it not? So that can also affect how you think about the business. Is there differentiation of the product? This happens in monopolistic competitive markets, right? So you have differentiation of product. How does that? I mean, what you are thinking about it? How does differentiation of product affect the ability of the company to, influence price, to influence quantity of its product, to influence the sale of its product, and all of that? Or is the company, adopting a focused corporate strategy, which means is it appealing to a particular sector of the economy or a particular demography? Maybe the product is meant for only the old people, or for females, or for males, or for children. All of those things can also help you understand the business and also affect in some ways the evaluation that you conduct. And then you have sensitivity analysis. This is something that is also very important because when you are doing valuation, you are bringing together different economic parameters, different financial parameters. We talk of cost of equity, we talk about the cost of debt, we talk of weighted average cost of capital, we talk about maybe return on equity, sustainable growth rate, a lot of different parameters that you bring together. Then when you are doing sensitivity analysis, you are thinking about how changes in those parameters affect your valuation, because that is something that is very essential. I mean, if you see a valuation, that you see an equity report, you see the valuation, and you don't see sensitivity analysis, you don't want to rely so much on that kind of valuation. Sensitivity analysis is very crucial when you are doing valuation because it helps you to estimate how changes in your key parameters affect your value. Because at the end of the day, a lot of the things you do on that valuation is based on your judgment as the analyst. You are thinking about the future. Who knows the future? Nobody knows the future for sure, right? So it is about what you think about the future as the analyst. You have your judgment coming to bear when you are doing valuation. So you have to then think about, okay, what if my thinking is wrong? What if cost of equity is not maybe 10%? What if it is 12%? What if it's lower? What if it's 8%? How does that affect my value? So that's where you talk about sensitivity analysis. Okay, then the second process or thing during the process is forecasting the company performance. And I mentioned that briefly also under financial statement analysis. So you have to do forecasting, which is also based, largely on the analyst thinking, analyst judgments. Okay, so you look at the quality of earnings. Is the earnings what you can you rely on it? Is the earnings sustainable? Is the performance sustainable? How accurately does the reported information reflect economic activity or reality, so that you can then make your adjustments as might be needed when you are doing your valuation or when you are doing your forecasting the company's performance. The third one is to select appropriate valuation method, and I think this is one of the majorly testable items in this section. I mean, everything is testable, right? But I think this is one of the majorly testable ones, because your valuation is as good as the model that you've adopted. If you choose a wrong method, then your valuation, your results is going to be, it's just going to fall apart. It's not going to be anything to write home about. So this is a very critical process during the valuation process, selecting the appropriate valuation method. And then under this, we have two major categories of methods. two major ones. You have the absolute valuation models, and then you have the relative valuation model, or what we call method of comparables. Under the absolute models, you are looking at the company on its own, and then you are thinking about, or you are looking at the metrics that deal solely with the company without looking at any comparable. So what happens here is you are looking at the fundamentals of the company. What are the things that determines the fundamentals of the company? The company's earnings, the company's dividend payments, the company's cash flows. Those are the things that you are looking at to determine, to measure valuation, or to calculate your valuation. Okay, so you have the discounted cash flow method, which is one of the most popular methods that you would hear many, valuation experts or those who conduct valuation talk about. So when you talk about discounted cash flow, it's just saying that you have some expected cash flows into the future and you are discounting them, you are bringing them to the present. So if you have cash flow 1,000 naira next year, for instance, how much is it worth today? So when you look at inflation, I mean, just looking at one parameter that we can all think about. So if you have inflation increasing, 1,000 naira next year is not the same thing as 1,000 naira today, right? And I believe, I mean, this is one of the things that you must have also come across during your level one, where you do present value, you do discounting. Okay, so that's what discounted cash flow is simply saying. So we have measures of cash flow into the future, and then we are bringing them into the present. We are discounting them to the present. One of the major measures of cash flow that is used here is dividend. And then when you are using dividend as a measure of cash flow, you talk about dividend discount model. We are going to see some of these things as we progress along, hopefully time permits us. Then you have company level cash flows, where you talk of free cash flow to equity and free cash flow to firm, and residual income. I'm not going to dwell much on them for now because there are subsequent slides that talk more about each of these methods. And then you also have asset-based valuation. We'll see that as well. Then you have relative valuation or comparables, as I said earlier, where you are looking at one company, against its comparables. So remember, for the absolute valuation models, you are looking strictly at the company you are valuing. You are not comparing with any other company. But when you are comparing the value of a company, or you are trying to measure the value of a company based on some parameters from its comparables, you talk about what you are doing is relative valuation. So I'm measuring the value of this relative to some parameters from its comparables. So the major methods, or we have different ones. You have the price-based multiples, you have the EBITDA-based multiples, right? So under price-based multiples, examples are PE, you have PE ratio, that's the price to earnings ratio. You have the price to sales ratio, you have the price to book ratio. And just to mention a brief point here that might come handy, I don't know where, but it might come handy, is that price to book ratio is mostly used for banks, right? Price to book ratio is mostly used for banks. And that's because what is driving banks is typically from their balance sheet. So if you think about banks, they give out loans, but that loan is determined by how much assets or liability rather they have, liability in terms of deposit. So if you and I take our money to the bank, we deposit it, it is that deposit, a part of that deposit that they use to make their assets, which is their loans. And from there, they earn their interest income, which goes into their profit or loss statements. Essentially, saying that what drives the income of banks comes from their balance sheets, comes from their book value, right? So you use price to book ratio mainly for banks. Also, residual income is used mainly for banks. Please just take note of that, just as a passing comment, but might be useful for you at some point. Okay. So it says, note, using more than one model can yield incremental insights. Yes. So we don't necessarily use strictly dividend discount model for company A and stop at that. We can combine different methods. We can use dividend discount model and combine it with maybe price to earnings ratio to conduct valuation. So we use what we call blended approach, or some people call it triangulated approach, right? So you can combine different methods and you assign weights to those different methods to arrive at your value. So they just want us to know that using more than one method can yield incremental insights. It doesn't necessarily always yield incremental insight, but it is possible, right? Okay. Then the next point under the process is converting our forecast to valuation. So we've done the forecasting, we've understood the financial statement, we've done the forecasting. We then need to convert that into valuation. But some of the things we need to bear in mind here, here in this bullet point. So one is sum of the parts. So you can be conducting valuation for a conglomerate that has different, different business units that are in different units. So let's say you are valuing Dangote, for instance. I mean, many of us know Dangote. So if you are valuing Dangote industry, for instance, under Dangote industry, you have Dangote cement, you have Dangote sugar, you have Dangote refinery. You have different things that make up Dangote, Dangote Industries as a conglomerate. These different companies are in different sectors. So it won't be too good to just apply one method to Dangote Industries as a whole. It will be best to value the different segments separately because they are in different sectors of the economy. The drivers of the income, the drivers of the financial parameters are different for these different parts that make up the industry, Dangote industry as a group. So when we then value these individual elements separately and do a sum, that is what we call sum of a part. So it's just a way of saying we are valuing a conglomerate or a business or a company that has different businesses operating in different industries. We value those different companies separately and then we bring them together to get the value for the group. That is sum of the parts. And when you are doing that, we apply what we call the conglomerate discount. Conglomerate discount is just to say that because these different companies that make up this group are in different industries, to be able to oversee the entire company, there might be some inefficiencies, essentially, or there might be some things that you just need to take out or to adjust for. So that is what you use your conglomerate discount for. You apply that when you are doing some of the parts. And then we need to bear in mind that the method we are using must be consistent with the characteristics of the company. Remember when I said that under selecting appropriate valuation method, the method you use or your value is as good as the method you have selected. So if you choose a valuation model that is not consistent with the characteristics of the company, then your valuation, I mean the intrinsic value that you've arrived at cannot be relied upon. So you have to choose a method that is consistent with the characteristics of the company. And lastly, we have applying the valuation conclusions. We just talked about, we have to consider risk factors and state them. You have to distinguish between fact and opinion because remember, a lot of the things that you do under valuation are based on your opinion, based on your judgment as the equity analyst. So you have to bring in a lot of discretion, what we call analyst discretion. So you have to then distinguish between your facts and your opinions. Which one is fact? Which one is your opinion? So when you are writing your reports, equity reports, then you have to distinguish between these things. Okay. And they also want us to disclose, we disclose any potential conflict of interest. Would look at some questions quickly that try to tie together some of these things that we've talked about and see, just get a pulse of how we are following so far. So I'll try to monitor the chat box. So the first question, I've just extracted some sections from a paragraph that has different sections, and then we'll just answer the questions under them one after the other. So on the second slide, the first question, on the second slide, Zilkin discusses some views about assessing where mispricing can occur. It states that companies that emphasize the efficient use of assets and employees to reduce costs in all customer segments are more successful than other companies in the same industry that tailor products and marketing to a specific customer. Okay, with respect to this slide, which of the following strategies best describe the strategy used by more successful companies? Okay, so what he's just saying here is, I'm trying to bring the charts. How do I do this now? Okay. All right. So the question we are being asked here is, okay, this is around there. Okay, so with respect to the second slide, which of the following is the best strategy or this best describe the strategy used by successful companies? So we are told that successful companies, they emphasize the efficiency of assets to reduce costs in all customer segments. Yes, that is cost leadership. Thank you for your answers. That is okay. Somebody said focus. No, this is not focus because it's talking here about reducing costs in all customer segments. It didn't say in a particular customer segment. So if it was in a particular customer segment, we can begin to think about whether it is focus. But this is talking about reducing costs in all customer segments, right? So this is C, cost leadership, not focus. Question 2. They said on the third slide, it states that another technique for determining mispricing is to solve for revenue growth implicit in the market price and then make a comparison to projected industry revenue growth and the size of the customer base. The analyst can then determine if the company's revenue growth is realistically achievable. Okay, so the technique described in the third slide is most likely an example of what? So they said it tried to solve for a revenue growth implicit in the market price and then make a comparison to projected industry revenue growth and the size of the customer base, okay, to see whether the growth is realistically achievable. So which one is that? Is that sensitivity analysis, solving for a catalyst, or inferring a market expectation? Okay, please, when you are putting your answer, maybe just so that we can distinguish between which one is which, maybe put the question number. So 2C, 2B, that kind of thing. Okay, so I believe we are all saying C for question 2 as well, which is correct. Yeah. So it's trying to infer a market expectation to say, okay, this projected revenue growth, is it realistic? Because that's the last statement. It says the analyst can then determine if the company's revenue growth is realistically achievable. Because you have to sense check. I mean, that's the word we use, right? Sense check. You have to sense check what you are doing. So that is inferring a market expectation. That's correct. So question 3. On the last slide, Zilkin continues with the topic of pairs trading. She mentions that stocks with similar PE ratios within an industry will be grouped for further analysis. Okay. Generally, company level projections for revenue and cost will be compared to group aggregated projections and industry-wide projections to determine above and below average performance. So the analysis in this last slide is best described as what? Okay, 3A, I can see 3A, 3A. Yeah, that is correct. That is correct. Because here you are then comparing, you are bucketing companies that have similar PE ratios together and comparing them to the company that you are valuing at the time. So that is relative valuation. That is relative valuation. That's correct. Question 4. I believe in solving a lot of questions because I think that is one thing that can help, solidify the understanding that we have, for any topic, essentially. So we have a couple of questions for this particular one, just as a building block, right? So question 4, the public market value of a diversified company is lower than its sum of the parts valuation. This difference best describes what? Okay, 4C, conglomerate discount. That is correct. That is correct. Conglomerate discount. Thank you very much. Question 5, an analyst selection of a valuation model should be such that the model is consistent with what? A, the characteristics of the company, but not the analyst perspective. the analyst's perspective, but not the characteristics of the company. Both the characteristics of the company and the analyst's perspective. 5C. Okay, I can see answers already. 5C. Thank you. That is correct. So the model you choose should be consistent with both the characteristics of the company and your own judgment as the analyst, your perspective. What do you think? What you think must also come into play when you are choosing your model. Okay. Question 6. Company A is an employment services firm with no debt and has fixed assets consisting primarily of computers, servers, and commercially available software. So this company has no debt. Okay. Many of the assets are intangible, including human capital. The company has a history of occasionally paying a special cash dividend. Occasionally paying a special cash dividend. Based on this company's characteristics, which of the model is most appropriate? Okay, asset-based, dividend discount, free cash flow to the firm. Okay, I think everybody is going for free cash flow to the firm. Okay, and that is correct. Free cash flow to the firm. That is correct. You use asset-based when the company has tangible assets. In this case, we are told that many of the company's assets are intangible. And then you use dividend discounts if or when the company pays a consistent dividend over time. So the company has paid a consistent dividend, and you also expect that they will continue to pay that dividend consistently. But here we are told that the company only occasionally pays special cash dividend. So dividend discount model is not appropriate for this company. What is appropriate is free cash flow to the firm. Okay. Question 7. Yes, someone is already answering 7. Okay, so let's see. They said company B operates in 3 unrelated industries with differing rates of growth. Okay. The company pays a regular dividend that is solely derived from the earnings produced by the tobacco division. Okay. So based on this company's characteristics, which method is most appropriate? Some people went for A, some people went for B. Okay, so we need to address this. So asset-based or sum of the parts or dividend discount. Number one, we can rule out dividend discount because the dividend is coming mainly from one of the divisions, right? So we can't really rely on that dividend to value the entire company. So we can rule out dividend discount model. Now, is it asset-based or sum of the parts? We are told that this company has 3 different, it operates in 3 different industries with different rates of growth. Should we use asset-based or should we use sum of the parts? We are not told anything mainly about the assets of this company, right? But what we know is the different, you have 3 different industries that contribute to the earnings of the company. But if you also look at the components of the assets, you have the tobacco industry, you have the shipbuilding industry, and then you have the aerospace consulting industry. So you have a consulting. When you talk about consulting, you don't really have tangible assets there. What you have is consulting is mainly human capital, which is intangible assets. So from that perspective, we can put a question mark on asset-based because you have one of the industries that does not have tangible assets. And then you have some of the parts. So you already know the contribution of the different industries to the entire company. So I think the most appropriate method here is going to be sum of the parts because you can value the different industries separately. Note that what they're asking for is the most appropriate. You might also be able to use asset-based, but because of the fact that you have one industry that has, that does not have tangible assets, asset-based is not going to be the most appropriate. It might be appropriate, but it's not the most appropriate because you have to be careful. I mean, watch out for those things. I mean, you've already scaled through level 1 anyway, so I'm sure you are used to least appropriate or least whatever, least likely, most appropriate, most likely, and all of that. So the most appropriate for this company is going to be the sum of the parts because we can value the different the different sections separately and then bring them together. Okay. So question 8, we're almost done on these questions. Company B has finalized the terms to acquire 70% of the outstanding shares of Company X. And Company X, which is an actively traded tobacco company, in an all-stock deal. Right. The question is then, which of the following is most likely to be appropriate to consider in Company B's valuation of Company X? Company X is an actively traded tobacco company. Company B wants to acquire this company in an all-stock deal, but they want to acquire 70%. So which one should they consider? Blockage factor, control premium, lack of marketability, discount. Okay, I think everybody is going for B, which is correct. Thanks for the clarification. Okay, yeah, you're welcome. Okay, so here control premium. So you apply control premium when you are acquiring the majority of the shares of the company you want to acquire. So here, Company B is acquiring 70%, which gives them controlling interest. So you have to apply control premium when you are doing your valuation of Company X from Company B's perspective. Okay, thank you for your participation so far. Question 9. Goatman explains that spas and personal service businesses are usually valued using a multiple of gross revenue model. He makes the following notes for his file. Due to the competitive strategies of the two chains, I will be able to apply a higher multiple than the industry average to value both businesses. I will be able to apply a higher multiple than the industry average to value both businesses. The model Goatman suggests for valuing spas and personal businesses is best described as what? Okay. I can see 9B, 9B. Yes. Here you are using multiple. So whenever you are using multiple that's you are comparing with comparables in the industry, that is method of comparables, which is also called a relative valuation. That is correct. B is correct, relative valuation. Okay, the last question on this slide. An investor implements a peers strategy that she expects to benefit in any market condition. The most appropriate valuation method to use to identify peers is a what? So you have an investor that what the investor uses is a peer strategy to understand how to benefit in any market condition. So the most appropriate valuation model to use to identify peers is what? Okay, so is it relative valuation? Is it asset based? Is it free cash flow to firm? I believe. Okay, Kevin wanted to type 10A. Yes, A is correct. So when you are talking about peers, comparing different people, different companies, comparing industry average, all you are talking about there is comparables, which is relative valuation. That is correct. Okay, so we'll move on to the next one. Thanks for the active participation. Let me see how many more minutes we have. Okay, we have about 45 minutes left. So discounted dividend valuation, DDM, discounted dividend model. We have a bunch of learning outcomes, but I'm just going to go straight into the first slide, which is the first introduction into helping us to determine how to choose the appropriate valuation model when we are conducting valuation. For your discounted cash flow model, you have three major cash flows. You have dividend, you have free cash flow, either free cash flow to firm or free cash flow to equity, and then you have residual income. So how do you know which one to choose? I think this is one of the most testable parts of the curriculum, as I said earlier, because it is very crucial. If you can do valuation, if you can know how to do a particular method very well, but if you apply that method to a wrong company, then whatever you've done is, I would just say is useless, cannot be relied upon. So it's very important to be able to select the right method when conducting valuation. Okay, so DDM, you use DDM when the company is is a dividend paying company, that means the analyst has a dividend record to analyze. So you have a company that has been paying dividend over a period of time, maybe over the last 5 years, they've been paying dividend consistently, and the dividend has, the payout ratio is maybe consistent, either the payout ratio or the dividend amount itself, maybe in naira value, for instance, is constant, is not necessarily constant, but there is a logic to it. Maybe they are adding a certain percentage every year. So you can say, okay, based on that, I can forecast what dividend is going to look like into the nearest future. Or maybe they have a consistent dividend payout ratio. So out of their earnings, they maybe pay out 40% every year. So maybe 40%, somewhere between 40 and 45% within the last 5 years. I mean, just as an example. So you have a company that is paying dividend in a regular fashion, either in terms of the ratio or in terms of the absolute naira figure or dollar figure, as the case may be. So you can use dividend discount model for such a company. Okay. The board of directors has established a dividend policy that bears an understandable and consistent relationship to the company's profitability. I've just mentioned that based on dividend payout ratio. So they've said they've given a guidance that will pay out somewhere between 40 to 45% of our earnings. We'll pay that out as dividend into the nearest future. Then you can apply dividend discount model for that company. Or the investor is taking a non-control perspective. So if the investor that you are conducting this valuation for is taking a non-control perspective, it makes sense to use dividend discount model for such an investor to value that company. Okay. When do you use free cash flows? Whether free cash flows to firm or free cash flows to equity, when do you use free cash flows? When the company does not pay dividend. So if the company pays dividend and the dividend is consistent, you use DDM. If the company doesn't pay dividend, you use free cash flow. You can use free cash flow. The company is dividend paying, but dividends significantly exceed or fall short of free cash flow to equity. So if the dividend they are paying does not have any direct mathematical correlation with free cash flow to equity, it significantly exceeds free cash flow to equity, or it is significantly below it, you can use free cash flows methods to value that company rather than using dividend discount model, right? Okay, the third bullet point here, the company's free cash flows align with the company's profitability within a forecast horizon with which the analyst is comfortable. What this is just saying is that there is a reasonable relationship between the free cash flow of the company and the company's profitability for the foreseeable future. So you typically will do your, maybe you are doing your forecasting for the next 5 years or the next 7 years or the next 10 years. So if within that period, you have a reasonable relationship between profitability and free cash flow, then you can use free cash flow method. Or the investor is taking a control perspective. So you see, if an investor is taking a non-control perspective, you use DDM. If an investor is taking a control perspective, you use free cash flow. The reason is if an investor is taking a control perspective, the investor can determine what happens to dividend, whether you pay dividend at all, you don't want to pay dividend, or whether you increase dividend or you reduce dividend or you retain the same dividend. The investor that is taking a control perspective has substantial influence on dividend. So because of that, instead of using dividend for such an investor, you would rather use a free cash flow because the investor can influence dividend. So you might not actually be able to say, oh, this is what dividend will be, or this is what dividend is not, it's likely to be in the future. So for such an investor, so you use free cash flow method. And the third one is residual income. You use that when the company does not pay dividend as an alternative to free cash flow. So if a company doesn't pay dividend, you can either use free cash flow or residual income. Or the company's expected free cash flows are negative within the analyst's comfortable forecast horizon. So you can have a company that is having a negative free cash flow. If you have a negative free cash flow, you cannot use free cash flow in that instance. because your value cannot be negative. You can't get a negative value. It doesn't make any sense unless you want to liquidate the company. Okay, so if a company has negative free cash flows and they don't pay dividend, your best bet is to use residual income approach. Let me just quickly check the chat box to be sure that, okay, there are no questions. All right, I believe we are still following me. So moving on. What's happened? Can you still see my screen?
No, sir, we're only seeing you.
Oh, okay. I clicked something wrong. Okay, my screen should be visible there now. Okay, so moving on to more nitty-gritty on DDM. So you can have a single holding period, you can have a multiple holding period when you are doing your dividend discount model. But once you understand the single holding period, you can always apply the same knowledge to the multiple holding period approach. So essentially, when you say single holding period, you are just saying you have an investor. So currently in Nigeria, if you are familiar with the Nigerian equities market, you will know that this is the time when a lot of companies are releasing their full year financials and also declaring dividend. So a lot of companies have already done that between March and April, right? So, or between February and April, many companies have released their final their financial results for 2024 full year, and they've also either declared or some companies have already paid dividend as at today. Okay, so if you have an investor that is trying to take a position in the market based on he wants to get dividend next year, and he also wants to be able to benefit from what the price is likely to be next year of the product, so of the stock rather, you are talking about a single period. So an investor is saying, I just want to position myself in the market today such that I can take advantage of next year's dividend and next year's the price of the stock next year. Maybe you are expecting the price of the stock to be 15 naira next year, whereas it is currently 10 naira. You want to take advantage of that. And also the company pays dividend, you want to take advantage of that. That is a single holding period, right? So what you are just doing there is to say the value today. So you want to discount both the expected price next year and the dividend. You want to discount it to today. So your method of discounting, I mean, I'm not going to draw much on this as well because I believe you've seen this before in level one, in maybe quant or some other topic where you've done discounting. So you have your dividend today, the expected dividend next year, D1, you are discounting into the present, and also you add the expected price, also discounted to the present, and you can bring both of them together to just say, since the denominators are the same, so you have D1 plus P1, which is expected dividend plus expected price, and then you apply your discount rate to get your value, to get the current value. So with that understanding, I would like us to try the example on this screen. So example, suppose that you expect company A to pay a 4 naira 60 kobo dividend next year. You expect the price of the stock to be 53 naira in 1 year. The required rate of return for company A's stock is 8%. What is your estimate of the value of the stock? So if you could quickly do that in less than 1 minute. Give me a second. Okay. I can't see anybody's answer yet. So I'm also trying to do it now. So, okay, somebody said Mary 53.33. So let's see. So all you need to do is to say 4.6 plus 53, and then divide that by 1 point. So 1 plus 8%, so that's 1.08. Yes, 53.33 is correct. 53.33. That's correct. Thank you, Mary. Thank you, Aminat. And I believe more people are trying it. So I believe we've all gotten that 3.33. So, like I said earlier, multiple holding period is just very similar to single holding period. The only difference is the way you do your discounting. You'll be raising your discount factor to the power of the year you are looking at. So if you are doing 2 periods, for instance, you do your dividend in year one, you divide it by 1 plus R raised to power 1 because it's dividend in year one. You add that to your dividend in year two, but you then divide dividend in year two by 1 plus your R raised to power 2 because it is, you are discounting that for 2 periods. And then you discount your price as well for 2 periods because you're assuming that you're going to sell that stock in 2 years' time. Okay, so that is the difference, but it's the same concept as the first one, which is the single holding period. So I'm just going to move on quickly from there and look at this very important concept, the Gordon growth model. The Gordon growth model. What this Gordon growth model is just telling us is saying if you expect dividend to grow at a constant rate over time, how do you measure your value from there, right? So how does that affect your value? How do you measure value of a stock based on the assumption that dividend is going to grow indefinitely at a constant rate? It's going to grow indefinitely at a constant rate. So it leads us to a simple and elegant valuation formula, which we have here. So your dividend at any point in time is a dividend in the previous period multiplied by your 1 plus your growth rate, right? Since we've assumed that the growth rate is going to be constant, the G here is the growth rate. If it is constant, your dividend in any period, so let's say your dividend today is dividend yesterday multiplied by 1 plus G. Dividend in 5 years' time, so if you have D5 in 5 years' time, it's going to be dividend in the fourth year multiplied by 1 plus G, and it goes on and on like that. And from there, you can calculate your value. So if you have your dividend today to be dividend yesterday multiplied by 1 plus G, and you want to discount that to get your value. So what you are then doing is value today is the dividend multiplied by 1 plus G divided by 1 plus R, and you do that over the subsequent periods that you have, because you are saying dividend is growing indefinitely. So you have indefinite or multiple periods of time. And what that helps us to do, because it's like a geometric sequence with a constant growth rate, right? So you can then, you can summarize this formula, you can compress this formula into this, which is VO, this third one. The value today is the dividend today plus, multiplied by 1 plus G divided by R minus G, where R is your required return on equity, or you call it the cost of equity, right? And it simply collapses into VO equals D1 divided by R minus G. Essentially, if you have a question where they are asking you, they've told you that dividend today is, say, 5 naira, your growth rate is, say, 10%, and you have your required return on equity of, say, maybe 12%. So once you just plug them in, so your dividend today multiplied by 1 plus G is going to give you your dividend tomorrow, and divide that by R minus G. That gives you your value. Once you understand this formula, you can apply this formula in different methods, whether free cash flow to equity. The difference will just be your measure of cash flow will no longer be dividend, it will then be free cash flow to equity. Okay, and your R will still be your required return on equity or cost of equity. And if it is free cash flow to firm you're applying that to, you discount free cash flow to firm using WACC, weighted average cost of capital. Please, I want you to take note of that as well, in case that is confusing to some people. So if your method of cash flow or your measure of cash flow is a cash flow that goes to equity shareholders, your discount rate must be your cost of equity. or they can call it required return on equity, right? But if your measure of cash flow is something that goes to all the providers of capital, where you talk of free cash flow to firm, free cash flow to firm measures cash flow from the perspective of all providers of capital, both equity and debt, right? So your discount rate in that instance is going to be your weighted average cost of capital, because you need to consider the cost of equity and the cost of debt. So it will be your weighted average cost of capital. That's why if you are discounting dividend, if you are discounting dividend, if you are using dividend discount model, or you are using residual income, or you are using free cash flow to equity, your discount rate is going to be your cost of equity. But if you are using your free cash flow to firm, or you are doing enterprise value, what you are going to be using is weighted average cost of capital. Okay, I hope that is clear to everyone. And then on the right-hand side, we have a special case of fixed rate perpetual preferred stock, which is as simple as the value is dividend divided by R, because we have a constant dividend. So if you have constant dividend, it is the same thing as saying your growth rate here is 0. Because if dividend is constant, it means growth rate is 0. So anywhere you have growth rates in this, in this part, you have 0, which means you'll be left with D over R, which is what you have here. So this formula, both of them are similar. The only difference is for the fixed rate perpetual preferred stock with constant dividend, G is 0. So because G is 0, your formula reduces to D divided by R. Will D be D1 or DO? It does not, it won't matter, because whether D1 or D0, dividend is the same. Remember, it is constant. So dividend today is the same thing as dividend yesterday, is the same thing as dividend tomorrow. So it doesn't matter whether it's D today or D tomorrow, because it is constant, right? So if you pay 5 naira yesterday, it will also be 5 naira today, it will also be 5 naira tomorrow. So you see, it is the same, because that's what we've said. It's constant dividend, right? So it is the same. Now, the second point here says GGM can also be applied in cases where G is negative. So if G, your growth rate is negative, you can also apply your GGM, your Gordon growth model. So what you then have in this denominator would be R minus G. Ordinarily you would have R minus G, but if G is negative, then you'll be having R minus G, which is R plus G, instead of saying R minus G, right? So negative times negative becomes positive, okay? So Cynthia, I hope what I said about D being constant is clear, so that D1 or D0 there's no difference, because D is constant. Awesome. Okay, so moving on to free cash flow valuation quickly. Or before I do that, let me just say that, for this GGM, it is possible for them to give you value, they give you dividends, they give you the required rates, the return, and they ask you to calculate your G. It is possible, right, for them to they've given you VO, they've given you D1, they've given you R, or they might even give you DO. They might not give you D1, they give you DO, they give you VO, they give you R, and they ask you to calculate G. So once you remember this formula, you just make G subject of the formula, and then you can calculate back to get your G, because that is something I think is also testable. I mean, you should not always expect direct questions from CFA. Some questions can be tricky, but just understand what they are asking you for. So they might not necessarily give you all these parameters and ask you to calculate VO. It might be that they've given you VO and some other parameters, but they didn't give you G, and they're asking you to calculate G. So you should be able to, turn the formula around to get your G. Okay. So free cash flow valuation, we have just about 20 minutes more. Okay, we'll move as fast as we can, but I hope that we are getting one or two things out of this, So free cash flow to firm and free cash flow to equity, there are a lot of sections under this reading. So it also points towards that this is a very important thing for us to know. Because remember, once you depart from the sphere of a company that pays regular dividend, the next thing you go into is free cash flow valuation. So it is a very important, topic to also bear in mind. And I've just highlighted the formula for FCFE and for FCFF and FCFE for us. So when you talk of free cash flow to firm, what you calculate is firm value. Please, you need to watch out for questions where they're asking you for firm value or they're asking you for equity value. So you need to watch out for them. So you need to be careful to say, okay, what are they asking here? Is it firm value they're asking me to calculate or equity value? Because we can calculate equity value from firm value. They are not the same thing. Firm value takes the perspective of the entire firm, for all providers of capital. I remember I just mentioned a few, I think on the previous slide or two slides before that when you are when you are doing valuation from a firm-wide perspective, what you use as your discount rate is your weighted average cost of capital. Okay, but when you are calculating value from only the equity provider's perspective, what you use as your discount rate is your required return on equity, or in some places you can see it's called the cost of equity. Cost of equity. Okay, so coming back to this left-hand side, FCFF. So FCFF is discounted using WACC. We just mentioned that. So how do you calculate your WACC? We calculate WACC by, taking the weight of debt, WD is weight of debt, multiplied by the after-tax cost of debt, right? So the weight of debt multiplied by the after-tax cost of debt. After-tax cost of debt is just saying we remove tax, 1 minus tax times cost of debt, because debt has a way of shielding us from tax, or it has a tax benefit. Because when you pay interest on debt, remember when you are doing your financial analysis, you get to, after your EBITDA, you remove your depreciation and amortization, non-cash charges, before you then remove your interest expense before you remove tax. So it means interest expense has helped us, has shielded our earnings, a part of our earnings from tax. So we need to account for that when we are also measuring weighted average cost of capital. So you multiply the two of them, then you add the equity side, which is weight of equity times return, required return on equity, or your cost of equity. Okay, and of course, your weight of debt plus your weight of equity must equal to 1 or 100%, right? So that is very important. So there are different ways to arrive at FCFF depending on the first item you have. So whether you have net income or you have EBITDA, or you have cash flow from operations, these are just different methods that we need to be aware of. So using the first method, you have your net income plus non-cash charges, which is mainly depreciation and amortization. So you add non-cash charges, you add them back to your net income, you add your interest expense after tax, then you subtract your investments, your capital expenditure, your capex, which is fixed capital investment, and you subtract working capital investments. Okay, so I mean, it's just good to know these different methods or these different formula depending on the information, so we can apply any of them to the information that we have. Now, if free cash flow to firm grows at a constant growth rate, if G is constant, then we can say firm value is equal to FCFF in period 1 divided by WACC minus G. If I go 2 slides backward, you remember this formula that we have under this GGM, where we said the value today is the dividend in period 1, so DO multiplied by 1 plus G divided by R minus G. That is very similar to what we have here. The only difference is, what is our dividend? What is our cash flow here? Cash flow is no longer dividend because we are calculating firm value. So the cash flow is now free cash flow to firm in period 1, divided by our R is no longer R because we are calculating firm value. So we have to use WACC instead of R, right? So minus G. So they are very similar. The only difference is your cash flow is now free cash flow to firm, and your discount rate is now your WACC based on the fact that you are doing firm value. And if we come to the right-hand side, the similar formula for the free cash flow to firm it's very similar. The difference is your cash flow measure here is your free cash flow to equity, and your discount rate is your cost of equity. And if you come up here, if you can see my cursor, how do you calculate your cost of equity? So you can calculate that using your CAPM formula. Okay, because we are going to look at some questions now that's where we have to apply this. So your CAPM formula, you might be given, some information, financial information, and you are asked to calculate your capital assets. You're asked to calculate your cost of equity using the capital assets pricing model, which is CAPM, right? So you calculate that by doing your risk-free rate plus beta multiplied by equity risk premium. That's how you calculate your cost of equity. So your risk-free rate plus beta times equity risk premium. That gives you your cost of equity. Okay. Then we can also calculate FCFE by saying FCFF minus interest rates after tax plus net borrowing. This is just saying we can calculate FCFE from FCFF. All we need to do is to add back interest rate after tax and to add net borrowings. That's what we do to calculate FCFE from FCFF. That's an important formula to also bear in mind. And then we can calculate equity value from firm value. Remember, you calculate firm value by discounting your FCFF over time using your WACC. So if you have your firm value and you want to calculate equity value, you will do firm value minus market value of debt. That gives you your equity value. Remember, firm value is both equity and debt. So when you say firm value, you are looking at the value of the enterprise, both from all providers of capital, equity and debt. So when you want to calculate equity value from firm value, all you need to do is to subtract the market value of debt. Please take note, you don't use the book value of debt. They might give you information where they give you book value of debt, they give you market value of debt, and then you might, don't be confused at all. You use market value, not book value of debt. Use market value. Okay. So moving on quickly to some questions, and with the time we have left, we might have to end on this. We still have residual income, but I'm not sure we'll be able to do that. But I want us to solve some questions to practice here, and this might take some time. So the first question, so we have FCFF of 1.7 billion Japanese yen, FCFE of 1.3 billion, and then you have the WACC of the company is 11%. We're already given WACC. Required return on equity is 13%. FCFF is expected to grow forever at a constant rate, right, of 7%. And FCFE would grow at a constant rate of 7.5%. The firm has debt outstanding of 15 billion. The first question is for us to calculate, we have to calculate the FCFF. So what is the total value of the firm's equity? Okay, they're asking us for the value of the equity using the FCFF valuation approach. So that means we have to first calculate the firm value and then adjust for the market value of debt. Okay, is anybody trying this? It's a lot of information, right? So typically that's how level 2 and level 3 are. So you have to distill your information from all the data points that you need. You have to take them out from the information that you are given. Okay, so we have this information. We have to calculate the firm's equity value using the FCFF valuation approach. So is anybody done? Okay, Nkechi has 30.465 billion. Would cross-check that. Okay, so I'm just going to switch. To save time, I did these things on Excel. Oh my, it's on my other laptop. Okay, so it looks like, what do we do? Let me quickly send it to this. I forgot to send the Excel file. just so we can save some time. Okay, so while okay, I think a lot of people have very similar numbers, 40.475. Okay, so you can try question 2. So they said, what is the value using the FCFA approach now? So while I try to send the documents, you can lay your hands on question 2. Okay. Okay, Esther, 24.41, Nkechi as well. Okay, I'll just stop sharing for a second because I need to access my email. Where it's opening. All right. So I'm sharing this. Okay, I believe you can see my Excel file. You can confirm if you can see my Excel file.
Yes.
Okay, great. Thank you. So the first one, let me zoom. So the first one, what did we have again? We have 30.475. Yes, I believe that is correct. So if anybody was confused or didn't know what's happened there, so we have FCFF. We have to calculate the equity value using the FCFF method. So we have FCFF of 1.7. We're given a growth rate of 7%, WACC 11%. So what we need to do is to say, so if you see the formula here, so you have your FCFF multiplied by 1 plus G divided by WACC minus G. That gives you your firm value. But because what we are asked to find is the equity value, we then need to subtract the market value of debt from that firm value to get our equity value. So that's correct. Then question 2, I see a lot of people have also done that. So using FCFE, we have FCFE multiplied by 1 plus growth rate divided by RE minus growth rate. That gives us the equity value using FCFE. Okay, that's great. Question 3, we have to calculate WACC. So can we calculate WACC quickly? So remember your WACC formula, you have your weight of debt multiplied by after-tax cost of debt plus weight of equity multiplied by after-tax cost of equity. Once I see at least one response, because we don't have much time, at least one, then we can go and look at it in the Excel file together.
Larry, you're not showing the question.
We are not seeing the question. It's the Excel that is on record.
Let me see. Let me stop sharing and reshare them. I thought I was sharing my window. Okay, it should be up now. So this is a bunch of information. We need to extract what we actually need from here. Apologies. We can't see tax rates. Is there? This is tax rate, 40%.
Yes, that was when you were sharing the other your solution.
Oh, okay. Okay, right. Okay, we have 5 minutes to the end of the class. So for the other questions, so calculate the value of the firm, the total market value of equity, and the value per share. I'm just going to show us that on the Excel file, and then we can end the class on that. Can you see my Excel file? Well, let me just stop sharing and reshare so that we don't waste time on that. Okay, so we're told that weight of debt, I believe you can see my Excel file now. So weight of debt is 25%, weight of equity is 75%. You know, even, I'm not sure we were told that in the question, but remember we said weight of debt and weight of equity must always equal to 1. So if you have 1, you can just subtract one of them from, subtract that from 1, and then you get the other weight, okay? So 1 minus 25% gives us 75% for weight of equity. We're told so we have to calculate WACC. We need to first calculate the return on equity using our CAPM formula. So our CAPM formula, we're told that the risk-free rate is 5.5%, beta is 0.9, and then the equity risk premium is also 5.5%. So that's what makes this up. So we have the risk-free rate plus beta multiplied by equity risk premium to give us the rates, the cost of equity. Then the after-tax cost of debt, so we have cost of debt 70% before tax, and then we multiply that by 1 minus the tax rate of 40%. That gives us 4% for the cost of debt. So when we do, all of those, we can then calculate our weighted average cost of capital to be the weight of debt, 25%, multiplied by the cost of debt after tax, which is 4%, plus the weight of equity, 75%, multiplied by
the...
Yeah?
You seem to be rounding up cost of debt equity. Maybe you need to use 2 decimal places to show the full figure.
Oh, yeah. I mean, we can. I've just rounded everything up anyway. That can be done. So the values are what they are here. So this is an Excel calculation, so the numbers are there. So the WACC is eventually 8.89%. The weighted average cost of capital is 8.89%. Okay. Then we're asked to calculate the value of the firm value. We have the FCFF to be 1.1559, and we're told the growth rate is 4% for FCFF. So to get the firm value, what we need to do is to say the FCFF multiplied by 1 plus the growth rate divided by WACC minus the growth rate. Remember, when you are doing firm value, you use your WACC, not your cost of equity. You use WACC for firm value. But when you are doing equity value from that firm value, what we just need to do is firm value minus market value of debt. That gives us the equity value. And lastly, the value per share is simply equity value divided by the outstanding shares. But in that question, just to point out, we're giving outstanding shares in millions. So we needed to convert it to billions because these other numbers are in billions. So I'm just pointing that out so that when we see questions on exams, we have to be conscious of the units that they're giving it to us as well. Are they giving it in millions, in billions, or whatever, so that we make all the numbers to be in the same units before we can do any calculation. Okay, so because of our time, we are going to end on this today, and I wish you all the best. Are there any final questions, maybe in 1 or 2 minutes, and we can call it a day? Okay, I can't see any. So thank you for having me this afternoon. I wish you the best in your exam. Okay, I can see it. Inquiry's hand is up. Yeah, inquiries.
Thank you very much, Damilare, and thank you to everybody that participated in today's classes. We really appreciate our facilitators. We look forward to seeing everyone again tomorrow, starting at 12 noon for the classes. We have 3 classes tomorrow. We start at 12 noon. We wish you all the best, and till tomorrow, do have a blessed weekend ahead. Thank you.